is up 0.7% versus the estimate of a decline, but versus 8.9% year over year. I mean, this is basically what we're looking at right now. And I think that what you're looking at is a company that's struggling with the same headwinds as others, and yet with perhaps a weaker footprint than the ones that have consolidated a lot of the power, like Walmart and like Amazon.
Is there a macro story here?
It's a good question because they've dealt with inventory issues in the past. Is that really the hangover of that that's coming to the fore in some of these numbers? I don't know. The 9 a.m. call Eastern time from this company will be really instructive when it comes to that. How much is just a planning issue versus a macro issue?
I think, Tom, you raised the right question. In a high nominal GDP world, posting flat sales growth, perhaps not the one.
Well, it shows a challenge here, and Brian Cornell, I think, nicely addresses that, as he always does. He has two companies he's doing. He's got household items, beauty products, essentials, the stuff, food even at Target. They do a little bit of a food business as well. And then they've got this thing that they call discretionary categories. And people are not being discretionary with their discretionary spending because they're spending it on rent.
Well, it's funny you mentioned that, Tom, because discretionary is outperforming on the S&P 500 this year. Year-to-date discretionary is doing really well.
Full disclosure, with the few years I've had at this, I've never been comfortable with the word discretionary in sectors. In the Sam Stovall world, I've never been, I just don't, I've never gotten it. There's toothpaste. Is that discretionary? I don't know if it is or not. Is a bow tie discretionary? No, it's not.
Yes.
On and on. I hate the word.
Discretionary is... Bow tie absolutely should fit under that category. Might be a staple for you. It's very personal. I agree.
Tang is not discretionary.
But, it's actually a good point, and not necessarily about the bow tie. But when it comes to discretionary, how much are we looking at the resurgence in travel and experiences as supporting the discretionary spending while
the
other
casinos,
exactly,
the
versus
cruises,
and maybe
those crazy people that get on boats for a week.
How do you feel about that? I think we're gonna do that too.
Doing
Surveillance
great.
cruise. We're gonna resurrect that.
We're not. The idea of being stuck on a boat, no.
With us?
With you guys, absolutely. You're like family to me. I've got no problem with that at all. With strangers, no. I can't. No.
Well, we're going to do the surveillance cruise.
So many people have heard this rant before. You don't need to do it again.
Okay.
I'll save you. TK?
I'm still in shock that we have Mr. Verone back. Very good. Let's go to Christopher Verone now with Strategas and the Baird Company, who I believe is joining us by telephone right now, which is good, given he has 8 inches of snow to the north of New York City. Mr. Verone, you mentioned that there is a trend there, and it's a challenging trend. We dovetail it with Target, which we can all agree is a well-run company. What sectors show signs of life? What sectors of the equity market can we be comfortable owning given the moment?
Well, I think, Tom, what's notable here is how the market, despite a very good rally off the low, I don't think we should call this move monolithic at all. And there are certainly clear areas of strength, and there are also clear areas of weakness. On the positive side, I think we have to continue to tip our hat to the strength we've seen from the industrials, and not just domestically. I mean, the industrials, whether it's in Europe or Japan, the machinery names have been absolutely fantastic here. I think they're telling us something. Leadership last year in a difficult year, and also leadership so far this year in an up market, that sounds like something that is trying to communicate some secular story to us. So I really want to respect the message from industrials here.
So what's the message, and how do you trade it?
Well, I think intellectually we can all come up with something, right? Perhaps it's reshoring or onshoring or any number of things. What I'm more concerned about is you have big machinery stocks from every geography around the world that really haven't worked for the better part of the last 7, 8, 9 years, coming out of these multi-year bases, whether it's Japan and Komatsu, whether it's the U.S. and Parker Hannifin. We've been using this acronym EPIC. Eaton, Parker Hannifin, Ingersoll Rand, and Cummins Engines, EPIC. I think that's going to be a more important acronym than FANG over the next number of years.
So when somebody asks you, does that mean buy or sell? What do you say?
I think there's some pretty epic leadership that's coming from this industrials group. I like them all.
Chris Verone, suffering with the snow in Darien, Connecticut. Hey, Chris, we appreciate it. Thank you, sir. He was meant to come in, and then he couldn't make it
He's not suffering.
He's got 8 inches or something.
8 inches. A lot of the upstate New York and Connecticut areas got
Where was
that.
our 8 inches in Manhattan?
We were supposed to get, we didn't get any. Right. So last night, the boys were counting snowflakes. They were like, please let there be a snow day. Please, there's not going to be a snow day. 2.5 inches doesn't do anything, and it's melting. And they're like, it's not melting, it's sticking. Look at that car. I'm like, it's not sticking.
Do you get snow days in the era of Zoom for these kids after the pandemic? Because the pandemic killed snow days.
Yes, but we had this discussion, right? Does it matter if you have to do school via Zoom? And basically what it comes down to is school via Zoom is not school.
Oh.
And so it's better than having to go to school because then you don't have to get dressed.
They're not participating.
Didn't you see all those videos of people who would say, like, pretend the screen froze and then there'd be like cats moving behind them and things like that during the Zoom era?
Put a free shot there. I love that. I love that.
And people in the snow belt will understand this, is that we prayed there wouldn't be a snow day, because if there was a snow day, you were at home, and your father was such a hitter that he had a driveway that was like, you know, a road. It was so damn long, and he'd hand you the snow shovel and say, start at the street.
Yeah, city kids don't have that.
You'd pray that there wasn't a snow day.
England was amazing for this. You got a little bit of snow and the whole country shuts down.
Really?
You're just guaranteed. Yeah, you don't need 8 inches. You need a couple of centimeters of snow.
Is that
game over?
Wait, is that true, or is that just the Pharaoh household?
No, I mean, like, you know, we used to embellish things a little bit
I've
on the
witnessed,
way.
I've witnessed that. No, I've seen
But in the
100%.
UK, leaves on the railway line. That's the thing.
Well,
you know,
I mean,
just cancel train.
It's cancel show. Well, that's what happens down south too, because they're not prepared for it. They don't have the big, you know, inventories of salt and everything. And I told the kids, I'm like, no, just because it hasn't snowed this season doesn't mean you're going to get a snow day. But look, Mom, it's collecting.
Are they taking a day off or no?
They better not be.
Slippy sidewalk. They
give
should.
me a break.
You've got to stay safe, Bramo.
Vortex.
It's important.
Vortex.
Futures right now on the S&P, positive 0.2% as we close out the month of February. We get a little bit of earnings for you from the likes of Target. A little bit softer off the back of earnings. A cautious profit forecast from the company in the face of what is still high nominal GDP, given what we've got in this country at the moment. Discretionary goods, demand there, not great, as you pointed out, Tom, at that company. Yields are high this morning as well by 3 basis points on a 10-year, 394.54. Over in Europe, they're a whole lot higher, particularly in Germany at the front end, high there on a German 2-year by 5 or 6 basis points on the session, 3.13%. Hotter inflation in France, in Spain. It's Germany's turn tomorrow. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from that U.S. CHIPS and Science Act. The money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories here in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators endorsed false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied it promoted false claims about the vote. In China, media regulators are looking at ways to curb, quote, excessive video use among young people. No companies have been named, but short-form video content on platforms like TikTok has exploded in popularity. Regulations that restrict viewing time for minors could impact big tech giants from Tencent to ByteDance. And in the UK, home buyers are getting their best discounts in more than 5 years. According to the property portal Zoopla, the average reduction to an asking price this month was 4.5%, and it was just 0.4% last year. And shares of Zoom are higher today. The video conferencing platform gave an upbeat profit forecast for the current quarter. The outlook suggests that Zoom is finding its footing again after a dramatic boom and bust cycle during the pandemic. A cost-cutting push is helping offset a slowdown in sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We have not come to the reality yet that our concepts of demand and supply for labor, for wages, may not work the same way our textbooks told us they did for the last several decades. We know from history, if you make people poor enough, they will have to go back to work. But is that what we should be doing, and is that what central banks should be doing?
What a treat to have Francis Donald back from Manulife. Just absolutely brilliant. A breath of fresh air and asking some really important questions about central banks. When central banks say and use this phrase, we need demand destruction, softer demand, what do they actually mean? Well, what they mean, Lisa, as we know, is ultimately they want unemployment higher. They want people out of work. Now, I'm not saying that they would ideally like to see that, but that seems to be the mechanism that they're discussing when they talk about softer demand and lower inflation.
We were talking about this last night. What's the connection here? What's going to keep people from spending money if they have jobs and if they're being paid more? What is the transmission mechanism? Is it that they've got higher mortgage rate? Well, they don't, because guess what? If you've locked in your mortgage rate, you have the same one. So it shows just that it's very difficult to get inflation lower by the Fed's policy unless you get some sort of reduction in the workforce. And that's really, unfortunately, the byproduct.
Francis said it, Tom. She asked the question, is that what central banks should be doing?
Exactly. That is the heart of the matter. Is it a prescriptive policy to lower inflation? If we do something, we can move inflation down, or is it a greater system off of a pandemic, off of the Biden stimulus, frankly, the global stimulus that has to be worked out over time? The insight yesterday, Lisa, you weren't here, was the Taylor rule disparity that we see. I've never seen a modeled Taylor rule, which can, folks, everybody's got a different model, but it's up here and inflation's down, the Fed's down here rather, and that gap is bigger than it was at the heart of COVID. That's how out of whack we are.
Yeah.
I mean, we're massively, massively out of whack, and that's where you fall back on individual data, which you do in securities analysis. He's out of Tufts University in Boston. Michael Baker joins us, really quite good at D.A. Davidson on the core of what retail's doing. Michael, I usually don't do this, but I'm going to go LIFO, FIFO on you, which, you and I studied in school. LIFO, FIFO is back, and that means inventory's out the door. Target's one of the best run machines we have, the Swiss watch of inventory management. What are you learning about all of retail's inventory agony from Target?
The retailers have done a really good job in 2022, realizing that they made a mistake and working through it. This inventory issue really hurt a lot of retailers in 2022. Just about a year ago, everyone was pulled up and they got really over assorted, particularly trying to bring in inventory early in front of the supply chain issues that we had last year. And everyone just got over assorted. That was a big problem, but the retailers realized it quickly, right around March or April of last year, and aggressively moved market down. And it was a tough year for a lot of the retailers, but I think they got it done.
You make clear in your note, you look at it as a pandemic one-off in that Target and others will return. You raise your price target on Target a couple days ago, price target on Target a couple days ago. I got that out. But Michael Baker, what's the timeline where they clear the inventory challenge? Is it now? Is it into 2024?
No, they did it. Their inventories in the quarter just reported as of this morning were it was either up or down 3%. I have the press release right here. It was essentially flat, 3% down 3% at the end of the fourth quarter. At the end of the third quarter, we're up 14%. Mid-year was, I think, 35 and 45% growth. So they really succeeded in clearing out those inventories, and they start 2023 clean.
Michael,
so that inventory issue is now behind them. It's no longer an issue.
I was looking at some of the headlines as they came across after the earnings dropped, and I was pretty confused. They seemed pretty negative, and they also seemed kind of motley. Looked at an earnings drop, a profit drop of 43% in the fourth quarter, a forecast that came in under expectations. The shares are now higher by 4.6%. Yeah. How do you make sense of this?
Yeah, it doesn't surprise me. For two reasons. Three reasons you keep pointing to. One, this is exactly what happened with Walmart last week. Walmart reported a beat in the fourth quarter, gave guidance that was below consensus and arguably conservative. The stock opened down in the pre-market and then ended up being up. It's exactly what we're seeing with Target right now. I think the idea here is that margins are going to be better. Margins will hit their low in 2022, and they're going to be higher in 2023. So the analysts got a little bit too high in their estimates. I think the consensus estimate for next year is 5.3. We're at 4.7. They guided to something that'll be around 4.5 to 5 or so. That's up from 3.5 in 2022. So that's a good number. We're growing next year. We're just not quite growing as fast or recovering as quickly as the consensus estimates wanted. But two things. One, those consensus estimates to me are probably conservative. And secondly, we're heading in the right direction. 2022 was the trough for Target. 2023 will be better, and 2024 even beyond that. It might take a little bit longer than the consensus forecasts had, but to me, that's just a function of the analysts getting a little bit too aggressive here.
It's kind of hard for me to get my head around this. Are you saying that the market didn't really believe the estimates the analysts had put out there, that they basically thought they were highballing it and were expecting some sort of downgrade that Target put out there? Or is this Target basically lowballing it to set expectations low and everyone just says, we know what you're doing, so we're going to get ahead of that?
More of the second, I think. I think that Target is giving nice conservative guidance. I'm not necessarily saying that they're going to beat it by a tremendous amount, but I do think they're giving guidance that they believe they can come in ahead of by the end of the year. And I think it's the right thing to do at this point. The biggest mistake that a lot of retailers made last year was getting too bullish for 2022, and they have to guide down 2, 3, 4 times. I think Target guided down at least 3 times in the year. The management team's Brian Cornell does not want to do that again. So the estimates that they've given here are conservative. They show nice growth, but they're conservative. That's a positive in both sense, and I think that's why the stock's up this morning.
Well, now it's down. I mean, it's basically been flipping and flopping, and Target's been a lot more volatile than Walmart, and so we'll expect to track that. Obviously, we can't really make a read on the sentiment given some of the volatility. I am wondering, though, whether you think that they've worked through some of the idiosyncratic issues, whether it's inventory that Tom was asking about, or just competition in general on the digital side when it comes to Walmart, when it comes to Amazon.
Yeah, I think they're actually doing really well on their digital business. In fact, they've been one of the leaders in that space in understanding the idea that your stores can actually be an asset for your digital business rather than a hindrance. If you go back 10, 15 years ago or whatever it was, the idea was close all the stores. Stores are hurting the e-commerce business. I think Target understood early that they can use the stores to help supplement that online business. And so really the poster child to me as of an omni-channel retailer. So I think they've done a good job there. Competitive-wise, their same-store sales have actually been pretty good throughout this whole issue. It's right. For them, the biggest issue right now is mix. They are still a little bit more assorted to non-discretionary categories, discretionary categories compared to, let's say, Walmart. And that is why their margins won't grow as much this year as some of the analysts have thought. Still going to grow year over year, but just not as much as analysts thought.
Michael, what's your single best buy then? What has the mix that gets us out 1 year?
Well, in our 2023 Outlook piece, we put best ideas out as O'Reilly Automotive, as Dick's Sporting Goods, and Ulta Beauty. We also put out Target as one of our preferred ideas.
Yeah, Ultra Beauty, Lisa, is...
You're all about it, Tom.
Just very...
Ulta,
that, don't
not
you?
Ultra Beauty.
Whatever it is. Ultra expensive.
Beauty.
Ultra adds up.
Yeah, Ultra adds up. Do you spend a lot on Ulta?
Oh, we do. What we do is we have a very low price point, but we have many things.
Oh yeah, they try to
We
do
have
that.
many-
The
they-
small
they-
little
they
things.
succeed at doing that.
So when you go to pay, you pick out more.
Yeah,
That kind of
and
place.
it's like,
The pro
$5. It's only
tip here
$5 for,
is when you get the mance, you don't have counters in girls' bathrooms.
Sure.
That's the
Thank
pro tip.
Oh, right, okay.
You have
Good luck with
no
that.
counter space.
That's the professional advice.
That limits the number of units.
I'm sure you live in a happy household, TK. Michael Baker, D.A. Davidson, thank you, sir. Target stock all over the place, to Lisa's point just moments ago. The stock is now higher, Bramo. Hard to keep up with, up by 5.5%. Was lower, as you mentioned, and now it's positive.
Yeah, and it keeps climbing, almost 5.8%. I mean, you just watch it. But what Michael was saying there just then was fascinating. This idea that basically people are rejecting the view that Target is actually more pessimistic than the street, and that they're just guiding it down to basically set low expectations. That's what basically he's saying. And everybody has their gig, and so we know what your gig is.
Gentleman out on Twitter, John, makes me smarter this morning. He's got a fancy Deutsche Bank ad from India. This is the Damien Sassower world. How about a 7.5% 5-year CD with an annualized pop published at 9%? This is not crypto. This is Deutsche Bank. And of course, the issue is it's in Indian currency. So that's, you got an EM risk there, a currency risk there. But boy, has the rate structure changed. I haven't seen that since, I had no gray hair.
Well, high yield is starting to look a little bit more like high yield.
Yeah.
It's been a while. It was always junk.
It's a whole new world after
and
all.
not India. I'm talking about, say, credit.
Yeah.
Credit here in the United States. It's high yield again, finally.
Yeah, and people are going into it because of that, which is the reason why it's becoming less high yield. MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here we are talking about what does the landing look like? I'm looking backwards at 2022 and saying that looked like a landing to me.
The market collectively does not have a clue at this point in time. Hence, we're going to get a choppy market.
We're seeing the beginnings of a regime shift back to a point where interest rates matter.
We are moving back both in growth and inflation to what we would refer to as the old normal.
Disinflation is not a concept that is dead. It may be around the corner.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We should just do a whole hour of people saying, I've got no idea. I don't have a clue.
I think we do. I think that every morning people we have no idea.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz and Jonathan Farrow. Futures right now up 0.25% on the S&P 500. Plenty of data, Fed speak, all that good stuff through the week. We need to pick up on European CPI this morning. Hot in France, hot in Spain. TK, we're going to read on Germany tomorrow. There is a lift in Eurozone sovereign bond yields this morning.
Transitory further gone. This is the second tranche of hotter that we've had. And, I'm going to go back. People think it's physics envy. It's just the reality of you look at a trend on a chart and there's a vector. The vector on French inflation in no way, shape, or form signals disinflation.
And now all of a sudden we're talking about 4% potentially at the European Central Bank. Try and get your head around that. That is absolutely ridiculous. That's the ECB. Let's talk about earnings here in the United States. Through the week, get a ton from the retail names in America. Target, first out the gate. Bramo, I've got to say, let's put the stock price action to one side. Let's just look at the numbers. The guidance is poor relative to what was expected for the quarter and for the year ahead.
Correct, which is the reason why you'd expect the shares to be lower. They are not. They are higher. And this, to me, is really the question. Are people willing to look past any negative guidance and just say, they're playing a game with us, they're going to try to guide us down, and then they're going to hurdle over that lowered estimate, and we've got your gig, and we're going to get ahead of it and buy instead of just, waiting for the data to come out.
Now that we have Talebian gravity, the math is back to what it was 16 years ago. Just perchance security analysis actually matters. And you just heard that from Michael Baker of D.A. Davidson, who's truly expert on inventory dynamics. And the answer is, I guess it's up because, as he said, they're clearing inventory.
Well, they had a big inventory problem last year.
Yeah,
on the
and
good
they're
side.
Clearing it out.
As you know, it's been difficult for the retailers, that's for sure. That stock is up by about 3% in the pre-market. Let's whip through the broader price action for you. Futures are just about positive by 0.25% on the S&P 500. A lift in the equity market on the session, a move lower on the month as we close out the month of February. We continue shifting higher on a 10-year yield by 3 basis points. Your 10-year right now, Lisa, 3.94.54.
So we talked about the Target releasing earnings, the earnings release. We're also going to be watching the 9 a.m. earnings call that Target's going to be holding. I'm actually more interested in that, especially in light of the share price reaction, considering the fact that have they cleared out the inventory issues? What are they doing on the digital front? How significant do they see the deterioration in demand as the year goes on? 9 a.m. we get a home price data, the FHFA house price data, as well as the S&P CoreLogic Case-Shiller 20-City Index. I know that you love it when I say that, but it's going to decelerate, and that's the expectation. But by how much? Because you're starting to see a bit of a resurgence in some of the housing prices. Are you laughing at the name of it?
It needs a rebrand. It just needs a rebrand.
It's a Case-Shiller Index, but now it's like merged, and then it's merged. It's, this, and then it's like,
whatever.
Logic.
Right.
Okay.
It is what you said it was.
2:30 p.m. I am curious about this. Chicago Fed President Austin Goolsbee is going to be making his first public appearance in this role. He's giving a speech in Indiana, and he is a voting member. So let's hear from him. Let's see how far he thinks the Fed has to go. How far away are we from some sort of terminal rate? I think about Torsten Slok's no landing, and he kind of amended the no landing to no landing now and then a hard landing later because the Fed's going to have to raise rates so much. And so how much do we start to hear that kind of view?
It's an important clarification, and Neil Dutta of Renaissance Macro offered one in the last 24 hours as well. It's not that Neil and company are saying the economy's never going to land, the economy's never going to weaken. The original pushback was against the expectation that we would see recession in early 2023, and they were pushing back and saying, no, that's not going to happen. And ultimately, the data so far, at least for the month of January, has pretty much confirmed that.
And then the flip side of that, if we don't get that recession, do we get an even harder landing on the other side because of what central banks have to do, a 4% ECB rate, a potentially 6% Fed funds rate?
We get lucky this morning. Wei Li's with us. Wei Li, good morning. From BlackRock. Wei Li, thank you for being with us here in New York City. You came into this year conservative on equities. The equity market rallied. You stayed conservative on equities. The equity market started selling off. You're still cautious. Can you walk us through why?
I have no clue. Just to add to your
we can go to the montage. That works perfectly.
Of things, but the reason that we're cautious on equities is really that if you look at where valuations are, it's pricing in still a very modest kind of growth outlook for the economy as well as for earnings as well. And if you look at where rates are, as you know, we have been of the view that they cannot cut rates. Now markets are moving closer to our view, but markets are still looking at rate cuts later in 2024, and we think that actually, given how resilient economy has been and how much the recession will be pushed out later down the line, actually rate cuts also needs to be pushed out further as well. So equity markets in developed world are not quite appreciating some of the macro challenges that we see happening, and that's why we have been prudent. Now, having said that, our time horizon is 6 to 12 months, and some of that metrics that we use to support the cautious view is valuation based, but that is not to say that we cannot have shorter term bouts of rally, which we saw in January, right? Like driven by technical factors, short squeeze, driven by FOMO flows as well. Real money investors are telling us that, you know what, after a year like 2022, they cannot afford to miss the rebound. So they're just going to pre-position for that, even if they know or they fear that it could get worse before it gets better.
In your beautifully elegant note, you talk about a new regime. I'm going to label it a BlackRock new regime. Larry's probably going to go, no, it's a Wei Li new regime. But whatever it is, it's a new regime. If we're not going back to securities analysis and factor analysis pre-2020, what are we going forward to?
While the new regime is predicated in terms of the macro drivers of the current environment, that we are moving from the great moderation with economic cycles shaped by demand to the current environment shaped by supply and supply constraint in particular. Factor analysis is difficult because factors are time-varying concepts, and factors can mean different things to different people.
I got to interrupt because we got to do a mathematical clinic here. I mean, right now we've got a Taylor rule as divergent from Fed policy as we've ever seen. If you do the partial differentials of factor analysis, I get the idea it's mud out there. You have no idea visibly where you're going. If you do the partial differentials across any Fed theory now, do they work?
At this juncture, no.
Thank you.
At this juncture, no, just because of how unstable some of the forces are, right? Like, so thinking about, you know, like R star, you know, one could see actually it moving temporarily before settling back down, given the kind of environment that we see right now. So as it translates into factors, it's tough to apply the old playbook to factor investing. You know, like people say, as we head into recession, we got to shy away from value, but we're also in an environment where rates are going higher, and curve, in our view, should steepen over that 6 to 12 month horizon. So we actually think that there is more room for factor value to perform, but we want to be a bit more selective. So we apply a quality tilt to the typical factor exposures.
When you talk about rates going higher from here, HSBC's Stephen Major put out a note this morning where he said the debate in bond markets today is whether to buy and hold short-dated bonds at close to 5% or go for the longer ones, which are almost 4%. And it goes to this belief, are rates going to go higher and stay there for a longer period of time? Or, you know, do you want to capture just what you can get at this point? Where do you fall on that debate?
The former. So we like front end of of the curve over the back end of the curve. You take very little duration and credit risk. You get paid. T-bill is paying you almost 5%, and commercial papers are paying you 5.5%. These are very attractive income opportunities. And given our view that actually rates will stay higher for longer, we don't necessarily want to kind of go into the long end of the curve, especially given how inverted curve is at this current juncture. Term premium should come back. It's underappreciating the degree that we're going to have to live with inflation, and we do want to kind of sit out and bunker down.
When will that value proposition change? When will the long end start to look more attractive to you, or even risk assets start to look more attractive to you than a 5% short-term rate?
I think it comes down to what extent macro damages are being priced in by markets. So the reason that we currently are shying away from developed market equity, we're modestly underweight, is because we don't see the macro challenges being fully priced in. So we're bunkering down in short end of the curve. But if market pricing changes, getting closer to our fair value, that would certainly change things as well. But also, we're actually on a global basis, we like emerging markets. We have an very modest overweight in emerging market equities. So think of our view currently as almost a barbelling between the short end of the government bond market in the US and emerging market equities on the other hand, given where the pricing and the valuation sits at this current juncture. The last thing I would say is that this is an environment with very heightened macro and market volatility. We have to change our views very quickly. We've already changed our views twice, and we're still in February this year. So, it's very dynamic.
Can we finish on China? PMIs this evening. How's the reopening going?
We have the view that actually reopening for 2023 should carry growth to something with a 6 handle for 2023. And that is off the very low basis of 2022 with a 3 handle. So clearly things have to be kind of viewed together, thinking about long-term growth trend. But we currently think that the growth pivot that we got a flavor of at the December Central Economic Working Conference actually will be further reinforced at the 2 sessions that are coming up in 2 weeks' time, and the PMI data actually could also give further evidence of that to that growth would come through in this reopening restart dynamics in China. But over the longer term though, structural growth in China is very challenged. By the end of this decade, we're seeing China growth stabilizing with a 3 handle. So we're talking about longer-term challenging, but near-term restart opportunities that we want to lean.
TK, 6% GDP this year, and then back down to levels like 3%. Invest around that.
Just so you're aware, he's in the final rewrite on the Faro 270-day outlook. It comes out March 31st.
It always comes down
very
March.
Smart, very
I wait for
smart.
things to go wrong in the first quarter.
Yeah, he waits for you to change your view 3 times, and then he puts out his
I'm not sure that would work if I actually did this professionally, but, it's what we do here at Bloomberg Surveillance. We wait a quarter. Wade Lee of BlackRock. Wade, thank you. Just awesome as always. Thank you very much. Coming up in the next hour, Sarah Malik of Nuveen. Futures up this morning. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Supreme Court hears arguments today on President Biden's move to slash the student debt of more than 40 million people. Republicans contend that the president is overstepping his authority on the move. Biden put a freeze on federal student loan payments on his first day in office. And a surprise inflation report today from both France and Spain, both seeing prices rise in February. Consumer prices in France jumped by a record 7.2% from a year ago. Meanwhile, Spain's inflation rate hit 6.1%. That's going to increase pressure on the European Central Bank to deliver more of those interest rate hikes. For the first time, markets now pricing in a 4% peak rate from the ECB. And in Ukraine, President Volodymyr Zelensky once again appealing to the U.S. and allies to supply advanced fighter jets for the war against Russia. Zelensky says an attack by drones that killed 2 emergency workers shows that Ukraine needs the jets. President Biden resists sending F-16s because of concerns that this could escalate the war. And Hong Kong ending one of the world's longest mask mandates after 945 days. Hong Kong leader John Lee says the city has completely returned to normalcy. This comes after the past 3 years of global isolation have weighed heavily on the city's economy and global standing. Shares of companies linked to tourism gained on the news. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
We have not seen China go all in with respect to supporting Russia. They have not condemned the invasion that Mr. Putin perpetrated now on the Ukrainian people, nor have they made a decision to provide lethal military assistance to Ukraine. And as the president said, he doesn't believe it's in China's interest to do that.
This topic is not going anywhere anytime soon. They keep hitting on it every single day. That was John Kirby there, the White House National Security Council spokesperson. We'll talk about all of that with Anne-Marie in just a moment. I want to touch on a price action for you just briefly. Equities have a lift, up a third of 1% to close out the month of February. Had some pretty dreadful numbers out of Target just in terms of the forecast, the outlook for this quarter and the rest of this year. And then Lisa's going to tell you why the stock turned around and is higher in the pre-market at one point by 5%, and now, Lisa, just by 1 full percentage point.
Look, I think that there is some idea that perhaps they're guiding lower and they're being ultra-conservative in their forecast to get ahead of the potential negative surprise, and then all of a sudden it's a positive surprise, and oh, look at that, their shares boom at the end of the year. That said, I do wonder how much people are just looking purely at the inventory issue. Have they gotten past that? Oh, yeah, they have. Okay, boom, let's go. Because they did pretty poorly last year compared to, for example, Walmart, and people might want to get ahead of any potential further gains. Again, there is this look for fear of missing out more than there is a look toward fear.
Wayley said it. Wayley said it. That stock, you mentioned Walmart versus Target. Target outperforming Walmart year to date as well, Tom. This year, not like last year, as Lisa mentioned, these names have really struggled, particularly with goods. The Target story that started, was it last May? Just the stock absolutely cratered. Anyway, Tom, this morning we're up by about 1.6%.
To me, it's all execution in the great big box no one's focused on is Amazon, and they have massive, it's really been in the press percolating here, this story, that story, another story of executing quicker delivery, executing the last mile, just simply executing at the ex-Bezos Amazon is a huge story.
Who do we get this week? Macy's?
Yeah.
Who else?
I'll find
Target,
out all
Macy's.
of them.
You
They're
give us
all
the calendar
coming
in a
out.
little bit.
Yes, in a second.
All right, okay. Look forward to that.
I know in
Thanks, I
Washington,
appreciate
Anne-Marie Horton used to, as a child, Anne-Marie Horton would go up and down the wooden escalators at Macy's day after day. I think we lost Anne-Marie. Oh no, she's up on the 8th floor with Santa at Macy's. Anne-Marie Horton joins us now of New York and, of course, Bloomberg's Washington correspondent as well. Anne-Marie, on China, as John says, it just won't go away. Do we have evidence or intelligence? Do we have knowledge or guesses that China is overtly assisting Mr. Putin in his war?
All we have is words from U.S. administration officials saying that this is something that they could see as a potential and they're looking into, but they have not offered this evidence. Of course, there was this report from Der Spiegel in the German press that there was potentially on the table a contract for lethal weapons for 100 kamikaze drones, potentially from a Chinese company that likely would have links to the Chinese Communist Party, because that's how it works, that would be going over to Moscow. But no, the administration has not provided evidence. And what I would say at this moment is the president really downplayed it with his interview with ABC News and said he really wasn't expecting China to do that. But the U.S. has come out, officials have come out, whether or not it's Jake Sullivan or Admiral Kirby or the president himself, saying that there would be these severe consequences on Beijing if they were to cross this line.
Well, okay, if they were to cross this line, is this imminent? I mean, what is the thing I'm having trouble with when I look at particularly the zeitgeist that's out there is I really don't have a timeline, do I? There's lots of conjecture, but is there an Anne-Marie Horton timeline of when things heat up with China?
I don't think there is a timeline at the moment. I think what you're seeing, what you are seeing in terms of at least what China is trying to put out into the world is that they want to be this global statesman trying to talk about quote unquote peace plan, this proposition plan, which is really a lot of similar tones and rhetoric we've heard from Beijing already. But obviously, if you look at that proposition plan, it would actually help Russia and Putin. But they're trying to say one thing and do another. We do know that they have helped Russia. In the essence, they're still buying tons of Russian crude and fossil fuels. This is how Putin is able to maintain his economy. And obviously, there's a ton of trade, actually, and the Kremlin has really been wanting to triumph this. There's been a lot of trade between Beijing and Moscow, more than what would have been expected because of the war. But this line about this lethal material, there really is no timeline, and we don't have any evidence of it.
There was a headline earlier this morning that the U.S. is setting a deadline to remove TikTok from all government devices coming up. And this has been an ongoing discussion. Some people might argue it's kind of interesting that there's TikTok on a lot of government devices. Are they making music videos? But there is a real question of what tangible business-related potential sanctions or regulations could go into effect as a result of some of the sort of jawboning that we're hearing from this administration. Has there been any development on that? Is this headline about TikTok indicative of anything further?
So this headline about TikTok that you're seeing, this we were expected. Congress had already voted on this. We knew this was coming. There's a dozen of states that have acted on their own state rights to do this as well. But Lisa, I'm glad you brought up TikTok because TikTok will be front and center today. Today at 7 p.m., it's the first time we're hearing on this China Select Committee from Representative Gallagher, and he's going to talk about wanting to ban TikTok. And then at the same time, also being marked up and voted on today in the House Foreign Affairs Committee is Representative McCall's bill on TikTok, which would basically allow the president to ban it outright. Now, this potentially has some pushback. Already, Democrat Representative Meeks from New York is saying that it's way too broad. But there is floating right now a number of TikTok banning bills in Congress. And, you know, when you hear from Representative McCall talk about it, he says his children say, "Dad, this is not going to make you popular." It goes back to your reasoning of why TikTok is on government phones. This is how they reach the youth in America. And that is why it is a major concern for Republicans and Democrats on the Hill. But today, with this kickoff, the China Select Committee, TikTok, sanctions on China, potential export controls, all of this will be front and center.
How much is there a sensitivity as some of these discussions go on about targeting the Communist Party of China and not necessarily Chinese, or making some sort of blanket statement? How much is there a sensitivity of trying to avoid some of the xenophobia and the McCarthyism that could potentially emerge from some of these discussions?
It's a good question. I think when lawmakers and leaders talk, they sometimes will just say China, right? But you bring up a good point. There is a big difference from the Chinese Communist Party and, of course, the Chinese people and Chinese companies that maybe were linked to the Chinese Communist Party. And at the moment, I sometimes see that there really isn't a distinction being made when people are using their choice of words.
MH, thank you. Over in Washington, D.C., an important conversation.
She did really...
Just a TikTok expert.
She did really well.
She's great
there
on TikTok.
Because it's so amorphous. I mean, as I said about the China timeline, there's no timeline. We're just everyday jawboning about this with China. There's no like diplomatic path here that I can see.
Ask these social media companies in the United States how getting access to the Chinese market is going.
What Chinese market for
How's
them?
that going for them?
Yeah, they're not getting involved with that.
And they're sort of stumbling and tripping all over the place because they don't want to upset their kids. Is that what Anne-Marie was alluding to?
Essentially, they're not able to advertise on TikTok, and so how are they going to reach the young people if they ban it? That's
so the White House
concern.
is simultaneously engaging this idea that you could have some kind of ban, but also at the same time engaging with influencers who use the platform.
Herein lies the issue. This is the conundrum
be careful.
wrapped
Lisa's
in.
an influencer.
She's an influencer. No, she's a financial influencer.
I am not on TikTok. I don't understand TikTok. I do want to just bring you this. So we have Macy's on
Good.
March 2nd.
That was smart.
We have
I like
Dollar
that. That was
Tree
really
on
good.
March 1st.
Nice.
We have also on March 2nd, we've got Costco and Nordstrom. So there you go.
Thanks for doing that.
Yeah, it was just on the tip of my
Appreciate it.
tongue. You
That's
could
all I was
tell.
thinking of at the time. Was just like retail coming up.
Well, you
Macy's.
would ask, it's a
Target
couple
out
minutes
a little
late,
bit earlier. Coming up, Robert Tipp, Chief Investment Strategist at PG Fixed Income. He'll talk about none of this. He'll talk about fixed income, what's happening in the bond market.
I'm
sure he's not on TikTok.
Let's ask him.
Greg Peters.
Greg Peters is very cool.
He's probably on TikTok.
Not that Rob Tipp's not, just that Greg Peters strikes me as the kind of guy that's on TikTok.
No, you think he does like music videos, like lip syncs
Greg
along?
Peters, have you seen some of the jackets he wears? Without a doubt.
Okay, we'll have to
Without a
ask
doubt.
him. Greg Peters, if you're
Dan
listening.
Ives is on the board.
I love it. You're just going to basically base people.
Making friends here, aren't we?
True story. True story.
Losing guests and isolating people.
One
here on
night,
Bloomberg Surveillance.
One night I downloaded the app of TikTok, whatever it is, and actually looked at it for an hour, and I was appalled by what I saw.
What did you see?
How any company can allow that? It was
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Equity futures trying to close out a dreadful month on a high. Equity futures right now up 0.4% on the S&P. On the Nasdaq, about half of 1%. What's that? Bring what up, Tom?
I haven't done the drawdown thing recently. I do that. I'm not going to do it right now and slow down the show, but the answer is off the rebound. No, we've had a little bit of a pullback, but still I'm nicely above the moving averages that I use.
Off the highs of the year,
it's
we're
not
down
the
about...
worst. It's not as gloomy as Bramo would make it.
Down about 4.7% off the highs of the year on the S&P 500 from the close of yesterday. If you look at the bond market, the moves we've seen have just been phenomenal. The US two-year yield on the month is up 60 basis points. If you take it from the intraday low, which was the first couple of days of February, the two-year yield's up by almost 80 basis points. Right now, just short of that, up by a basis point in the session, 479.29 on a two-year. This whole yield curve has just changed radically from 12 months ago. It's not just in the United States, it's Europe too. Just to see the German two-year through 3% and up 4 basis points on the session off the back of hot CPI in France and Spain. Let's finish on the Eurozone. You'll get a read on Germany, German CPI. You'll get that tomorrow. In a couple of days, you'll hear from the Eurozone in its entirety. But based on what we saw from France and from Spain so far, there is a feeling now you will get an upside surprise, a lift relative to what we were expecting just a couple of days ago. Euro dollar 106.10. We're just about unchanged. And TK, I've got to say it, we've gone from talking about maybe the ECB hiking, maybe getting back to zero, then perhaps going to 1, then 2, maybe 3, and now we're talking 4% of the Eurozone.
What does Christine Lagarde do with the unique fiscal structure and national structure, cultural structure of her ECB? To me, John, you're the expert on this. I defer to you, but to me, it's just a complete mystery because we've never been here. Duisenberg's never been here. Otmar Issing's never been here. Mr. Trichet's never been here. It's truly original territory.
Well, the good news for them is that the risk, if you look at Italy over Germany, the wides of last year were 250. That spread right now is 180. But I don't think that brings much comfort to Italy, who now look at an Italian 10-year of 4.5%, Tom, with the threat of maybe, Lisa, moving even higher than that. I don't think they're going to sit there and say, well, it's good because we're not at the wide to last year. I mean, the fact of the matter is that rates are a whole lot higher.
Are they going to have to raise rates higher, even though longer term it's going to mean a much weaker economy that we're just not seeing yet? I mean, do you have to have faith that it will work as it has in the past? And if so, stock buyers don't seem to have that faith, which is sort of this interesting conundrum that you're seeing right now. I'll give you an example. Front and foremost, Target, it came out this morning with earnings that were pretty poor, at least if you look at some of their forward projections. Full year adjusted earnings per share expectation of $7.75 to $8.75 versus an estimate of $9.25. Those shares were up as much as 5%, now up about 2%. People looking past the negative guidance and saying, you guys are going to be great. I mean, basically, it seems like you've worked through some of your inventory issues. Zoom Video video surging almost 7% at one point, up 7.6% after yesterday's earnings that showed better than expected fourth quarter results as well as a forward outlook. So I guess people are still using Zoom, even though, you know, perhaps people are trying to get back to the office. I don't like Zoom. I've got to be honest. Do you guys like Zoom?
I don't like Zoom either. Barely used it though. Got away with that.
Yeah.
I am, you know, people go blessed. I am so blessed.
You know how I
think
feel about
I've
meetings.
used it 3
I've
times.
got no time for meetings.
Well,
I hate meetings.
my issue is that gap when someone speaks and then it kind of pauses the other side. So people are constantly tripping over each other. It's like,
Do you know that stock's down from the high of the pandemic?
Oh, yeah. It's just been
from
crushed.
2020. That stock's down 87% based on the closing price of yesterday.
Well, people thought that Zoom was the new Office, and then it wasn't the new Office anymore. And
The new office, it was going to be the new office.
I mean, essentially, everyone was going to work from home, and kids were going to do school from Zoom, and everything was Zoomy. But also, I'm looking at Chevron, just to give you a sense, because we talked about their share buybacks and the potential a repurchase stock rate of $17.5 billion annually. This despite the decline that we've seen in oil prices, and this really goes to the existential angst of oil companies. Despite some of the pushback that we've been getting, you still are seeing them not invest as much of their cash in production because with their fossil fuels in 10 years.
They just have huge cash flow. They went from, I think it was 13 billion up to 30 billion, and Mike Wirth is rewarding shareholders. I know it's a raging debate, but to me, it's intelligent use of cash, whatever the firm is. There is a debate, as John, you mentioned with Warren Buffett. The basic idea here, are you buying shares at the top of the market or are you buying shares cheaply? I don't have an opinion on that, but that's the only real debate about shareholder buybacks other than not investing, but they're investing, right?
Do you want the Buffett quote? Because it's a pretty good quote, isn't it? From the investor letter over the weekend. When you were told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue.
Yeah, Mario Gabelli.
Pretty punchy stuff, isn't it?
Gabelli is heated on this as well. Is it? And to me, it's just all about taxes. I mean, that's all there is to it. We'll talk about that later. Over to the bond market, I'm going to ask a question I have never, ever asked. I can do that with Robert Tipp, Chief Investment Strategist at PGIM. PGIM is a really interesting house, including taking down all sorts of Morningstar awards in total return and fixed income over the years. Robert, I want to talk about the next shoe to drop in the fixed income world. So an open question. Not so much negative, what keeps you up at night, but simply what is the identifiable next shoe to drop out 6 months in your world?
Yeah, I think that's the thing that everybody's wondering about that's not going to happen. You know, the fixed income market was, for all practical purposes, murdered in 2022. We've had yields rewound decades back up to really substantial levels. And the markets clearly recognize the value. And whenever volatility has gone down, money has started coming back into the market. So I think that's why, while people are still looking for the hard landing, the excessive boom with too much inflation and where the next disaster is going to be, spreads are grinding tighter, and long-term rates, are not making that much progress higher. Even the 10-year bond, with the numbers that they're putting in there, is just reaching, slightly exceeding levels that were hit last year. So I think, we're going to be in the meat of the distribution rather than the tails here.
All right, well, that's a really nice way of putting it. And to carry that forward, all of a sudden what's changed is you have a coupon to work with. Are we reverting to institutional behavior of 2006 and before because we have a normal math market and a normal coupon?
I don't think we are yet. I think that investors maybe have not completely wrapped their minds around the fact that, these are substantial returns in fixed income. So I think there could be some asset allocation to happen there. I think the other education that's going to take place over the next couple of years is the trade-off between cash and long-term fixed income. I think that, eventually at some point in the future, we will see inflation coming back down to target. We may see some gentle drift back down in rates. But the people that stay in cash are not going to lock in the returns for the long term. So I think, that's the big trade-off here is, exactly when do you want to lock in the rates as opposed to have the certainty of, 4%, 5% on your cash.
When is that time?
I think we're pretty much in the zone. I think markets are having a very hard time pushing the 10-year Treasury over 4%. I think we're going to be centered around 4 until and if, as if the Fed gets above 5, and then you may see some pressure up towards 4.5. But we're pretty much in the topping zone. I mean, we're as low as 0.5% in the depths of COVID. We passed up through the 2% averages of the post-GFC environment, and we're now back to this century pre-GFC levels, and I think we're going to be kind of range-bound at this level.
What's your concern level about the potential for increased defaults? It's been sort of shocking to me that 4 years ago, people were saying when rates would rise and inflation ticked up, then all of a sudden you'd see this massive default cycle. And now people are saying, actually, the companies look great. They've locked in term structures that really immunize how much interest they'll be paying for a long time, and there won't be that many defaults. Do you agree with that and lean into riskier credit as a result?
I think that I agree with that. I think that the performance of credit has been better than some have expected. But companies have really been in the driver's seat since the bottom of COVID. They've been very conservative in their activities. They have held themselves back from overinvestment and the excesses that you've seen in so many cycles in the past. And I think, do you go into deep credit? I think it's a point in the cycle where you could risk that, but I think actually you don't have to reach to get the value. I think there's more value in intrust sector and, generally speaking, being over allocated to credit without reaching into things that have excessive downside risk.
When was the last time that you were this excited about presenting a potential portfolio return target to your investors, where you could basically say, look, you don't have to extend that far and you could easily get 8% on your overall portfolio? I mean, have you really had any kind of parallel to this moment?
No. All the times in the past when rates had popped up to this kind of level during my career, so going back longer than you would want to think, to the peak in interest rates, there's always been a secular bull market aspect. And so there was no real trade-off. If rates had a big back up, it was time to extend duration and go out to the back of the curve. It's a little bit more difficult case to make now because I think we're going to be range-bound. I think people don't realize that the vast majority of the time historically, rates have been at these levels. So I think we're going to be in a relatively steady state. I think that the increases in return for extending duration are going to be more subtle. They're going to be realized over long periods of time. But there is no exact comparable period looking back over the last handful of decades.
Robert, this is such a massive change for you. You and I have talked together for so long. Coming out of this pandemic, this is a real change for you and the team. How will this change your approach to fixed income?
Yeah, absolutely. It has not changed our approach to fixed income. And, we've always looked for the high information ratio trades, and there are high information ratio trades in the interest rate environment, given this curve shape, whether it's in relative value or whether you're looking at the excessive confidence the market has in terms of what exact form the course of the Fed funds rate is going to take. Those opportunities are there for positive carry that will profit from a reversion to a more normal shaped curve. And so there's been absolutely no difference. We've always looked for the fundamental value in the market, and that's no different now than ever.
Well, the yield environment is certainly different to what we saw a decade ago for much of the last 10 years. Robert, thank you, sir. Just phenomenal. As always, Robert Tipp there of PGIM Fixed Income. We're still trying to, I think, struggling to internalize these post-pandemic realities, Tom. Still, particularly in this fixed income market.
Between Whaley and Robert Tipp, I mean, you're getting a real sense of that. The people, again, making it up as we go.
That was a clinic, that's for sure. 8:30 Eastern Time, David Page of AXA Investor Management. That's going to come up in about 50 minutes or so. Up next, we're going to talk about energy. Crude right now, 77 on WTI.
Keep Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from that U.S. CHIPS and Science Act. That money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories here in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators did endorse false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied it promoted false claims about the vote. And oil headed for its fourth monthly loss in a row. West Texas Intermediate is down about 3% in February. Investors were optimistic about rising demand in China, but that's been eclipsed by concerns over tighter monetary policy and increasing oil supplies here in the U.S. And home buyers in the U.S. are increasingly paying in cash. According to real estate data analytics firm Adam, the share of all cash deals rose last year to the highest level since 2013. It was over 50% in 13 cities, including Atlanta. Meanwhile, the number of institutional investors declined, suggesting more regular buyers turned to self-funding to avoid those higher mortgage rates. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Consumers have consumed 13% less energy than they would otherwise have done because they're trying to economize. There's about another 10% saving coming from the weather. So we've consumed about 23% less energy this winter as a result of the weather and people changing. So that's really helped the supply-demand situation and left us in a much better position at the end of winter.
One of the biggest oil traders, if not the biggest oil trader on the planet, Russell Hardy there, the Vitol CEO. Crude closed out last year at 80.26. First trading day of the year, it closed at 76.93. WTI right now, 77. And I'm sure many of you are asking, China reopening. What reopening? Where is it in the commodity market? It's not in crude. 77 at the moment on WTI, up by about 1.8%. We can discuss a little bit more about that in just a moment. I want to talk about the bond market. Yields up in Europe. That's where it started a little bit earlier with French inflation, Spanish inflation coming in hotter than expected. Yields up here too by a couple of basis points on a 10-year, 392.98. Another read on Eurozone inflation later this week. You get German CPI, you get this regional breakdown. through the morning
Connection
tomorrow
lost.
morning, so look out for that. Euro dollar Tom just about unchanged at 106.11, and futures with a lift up a third of 1%.
Interesting to say the least, and John, help me here. I think the major theme today, which is really off the American radar, is the inflation trends in Europe are just stunning.
Without a doubt.
Can you imagine if we see those here?
The stickiness of it?
Yeah, not predicting it.
The problem is they were hoping it would fade, and it seems to be accelerating in certain places.
I don't know if we mentioned it. I don't think we have yet, but Torsten Slok out 40 minutes ago or so with a little bit of a whisper of housing good news and disinflation.
Hey, Neil Dutta, Lisa, Neil was talking about it.
Is this good news? I don't think it is. I mean, yes, it's great for people who want to sell their homes, but what you're seeing is a bit of a resurrection of some of the sentiment within the housing market, and Torsten Slok was putting out charts showing that. So mortgage rates go down just a little bit, and everyone floods back to the market, which indicates they haven't really diminished that underlying spirit and fervor.
Well, we'll see. We got Case-Shiller today as well. Always dated, but nevertheless important.
I think it's the S&P Core Logic Case-Shiller Index, isn't it?
Very well done.
Thank you.
That was beautiful. 20 City.
Just to clarify.
Stick a 20 City in there.
Carl Case of Wellesley and a guy named Schiller at Yale. They're the ones that put it together. It's hugely valuable, even though it is a little bit 60 days, I think, dated as well. We've always taken pride, particularly with Will Kennedy, of our hydrocarbon coverage, usually centered around economists. Think of Ed Morse, maybe, at Citigroup, or a guy named Curry at Goldman Sachs. But it is on the bid and the ask, and particularly looking out to the future, where a lot of information can be gleaned. He's legendary at Mizuho Securities. He has a privilege of working with Dominic Constam and Mr. Rasciuto as well. Bob Yager joins us this morning. Bob, you've been doing this a few years. Do you have transparency in knowing where the bid and the ask is? Is your market running normally?
It is running normally. We're stuck in a range, unfortunately, that we've been in since the end of November. We've been trading between $70 and $83 for 4 or 5 months now. So we are trapped in this range. It's the China story versus the inflation story, or the fight against inflation story. We have been stuck in a market structure known as contango, where the front of the curve is cheaper than the second month. And that's a weight around the market's neck. It just cannot get out of the mud. We're stuck in the mud here because of this contango market, and the proof is in the pudding. We were in basically a $10, $12, $13 range for months now.
Bob, you mentioned that tug of war. Let's talk about one side of it, one part of it, China. Has China just not reopened in the way people expected at the start of the year? What's your take on things?
I mean, you can't go from 0 to 60 in 0.1 second. It's going to take a little bit of time. A lot of the big barrel counters, the International Energy Agency in particular, who, in my opinion, is probably the most reliable, they're looking for Q4 for that real growth, and I would tend to agree with that. Like I said, it's too soon. We were just talking a couple of months ago about demand destruction in China, and now we expect them to be carrying the world on their backs to the promised land or something. It just doesn't happen that quickly, in my opinion. I don't think it's fair to the Chinese to expect them to be in that position either. But they'll get there eventually. It's just not going to be tomorrow or anytime in the near future.
Bob, how tight do you expect this market to be? There's been some talk that maybe Russian supply has just surprised to the upside, and that can offset some of the additional Chinese demand. How tight do you think it will be when that Chinese demand does eventually kick in?
I think we could approach $100 again in Brent. I don't think we're going to blow out to $130 like we did during the early days of the war, or into the war. But I think we could get to $100 based on supply and demand dynamics. Another problem is, though, you got to keep in mind, here in the United States, storage is at a 22-month high. We have a lot of crude oil here because we had a really warm winter. And distillate, that's heating oil, basically, storage, is it just never developed. And the relative price of heating oil to crude oil started to tank. If you don't need the heating oil, you don't need the crude oil to make heating oil. So that dynamic has really played out in a negative way as far as the whole complex is concerned also. Gasoline may be able to come to the rescue by Memorial Day. So there is some hope there also that will put a bid in the market. keep in mind, below $70, it's kind of the abyss. So it's a very, very important level versus WTI versus $70.
Heading into the abyss, you're starting to sound like the rhetoric that I can relate to. I am curious, though, Bob, as you start to talk about the potential for further declines, how you understand the driving season in light of electric vehicles. And I say this because it's kind of muddied the picture a little bit when people talk about some sort of downturn creating a negativity for oil prices and an upturn positive growth, causing oil prices to rise. We're not seeing the same levels of demand play through. Is it because of EVs?
I don't really think so. I think it's more of it's chipping away every day. Make no mistake about it. There'll be a time in our lives when it will be the dominant force versus gasoline. It will switch the other way at some point, but it's not going to happen in the next year or two. Fisker announced that they're going to put out a pretty big number of vehicles later in their production cycle here yesterday. So that's a brand new big chunk coming to market. But it's, for lack of a better word, it's kind of a spit in the bucket right now, as opposed to the inflation story where people are worried about the amount of money in their pockets and they're reluctant to go out and drive across the universe because it's going to cost them a pretty good penny. It could cost them significantly more as we approach Memorial Day, as long as price doesn't rally like it did last year to $5 and basically kill the golden goose in the process.
Bob, just before we let you go, we were talking this morning about Chevron's recent share buybacks. Do you think this is a sign that a lot of the oil majors just really don't see any prospects for more investment and just see shareholder returns as the best use of their cash?
I think there's a little bit to be said for that. You got to keep in mind they were in a pretty tough position for several years. This is a mini golden age for the oil producer, and they learned their lesson from increasing production at every opportunity, and they realize that that's not the way to run the bottom line. So they are now on track because they have adopted this formula of buybacks and dividends, and it's working for them. And their obligation to shareholder is done a lot better job.
Remember, President Biden said at the State of the Union, we need crude for at least another decade, at least another 10 years.
Yeah, what did Emery say? That was going to be rolled out in all
at least another 10 years.
Republican.
And then I think he said after, when people started laughing, more than that. Of course, it's going to exceed that. Bob, thank you. Bob Yorga there from Mizuho Securities. Thank you very much. Catherine Mann at the Bank of England, moments ago. The hawk on the MPC saying this: lower energy prices might push up consumer spending. Tom, we've heard that a few times.
Yeah, and, we have a huge respect for Dr. Mann, and I think that's Micro 101 that she used to teach at Brandeis, and I believe before that, I can't remember the details on it right now, but the answer is she's got the chalk in her hand, and she's at the chalkboard telling us what's going to happen.
Yep.
That's not the value add. The value add is the length of time we may see this. They're all trying to slow and break the economy. And as they B-R-A-K-E the economy, they may B-R-E-A-K the economy, and us as well. That's the challenge. Like that, I did that?
They're struggling to get CPI down. Let's put it that way. That's the bottom line. In the last week, there's been a story developing between China and the United States. The United States has been very transparent about this. They are worried that China may support Russia's war effort directly with lethal aid. Every single day almost, we've heard from one official or another talking about this. It's Secretary Blinken now speaking in Astana, Kazakhstan, and saying the following: the Xi-Putin no limits partnership, Tom, is, quote, a real concern.
I'm going to go, and I've been asked this like 5 times, John, in the last couple of days, and my answer is our intelligence capability knows a lot more about this than anybody's letting on. And I'm willing to say to authorities, okay, what do you know? Get to work. And we seem to hear from the Secretary of State they are monitoring this closely. And also what he said on sanctions. They're going to monitor the Dan Tannenbaum world, the efficacy of sanctions.
The White House has said there would be consequences. And the question, obviously, inevitably that's being asked is, what are the consequences?
Brammo could get on the list. I mean, Brammo could be on the sanctions.
Well, sanctioned.
Yeah, Russian sanctions.
With Dan Tannenbaum. I'm not sure where that came from. What's she done?
World?
What's she done?
Get sanctioned. No joy.
Today, what are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving. tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
The Fed wants to send a message that rates are going to stay elevated for an extended period, maybe as much as a year.
The nature of growth and how the slowdown is impacting the economy is likely to be uneven.
Most of the numbers are stacking up towards a second half recovery.
It looks like the Fed's doing the right thing, and that counts the most. It's the end of free money.
This is now about fiscal policy. We're entering the fiscal policy decade.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It's PowerPoint Tuesday. We welcome all of you here. Futures up 14, a nice lift to the market. We've been focused on inflation. We've done a lot in the markets. And John, a 118-page PowerPoint just landed.
Have you read it?
I've skimmed it.
I haven't read it.
Page 54 is where the story begins.
You managed to get that far already?
Well, I've done surveillance skim, we call that as well. Shonali Bassick with Mr. Solomon on an eagerly anticipated statement of the Goldman Sachs future. We'll do that later, but just with the headlines out now, I'm going to say, John, they're pretty vanilla headlines. They're the spirited effort of a firm trying to
What
convey the
headlines can you
message.
see? Because I haven't got any yet.
GS Equity CN is the secret code.
To reduce
thanks for that, Tom.
unbalanced sheet investments to $45 billion. It's a reduction next year, setting a target of $10 billion for management fees. Just going through some of the goals of the company. Really, the question is going to be about leadership as well as sort of their overall strategic targets.
Yeah, and what I'm going to do is make this real clear is the keyword is scale, like at Target and like the retail earnings that we've seen. And frankly, John, to your shock over ECB and a 4% potential rate, it's the scale of the effort. And they talk with their troubled banking firm, they need scale to make this work. Is that true of everything we deal with on surveillance?
Let's start with rates. Total game changer. Total game changer.
Total game changer.
To be thinking about the ECB at 4, maybe the Federal Reserve pushing 6, unthinkable 12 months ago. And that's what the bond market and all of these companies have got to grapple with, Tom.
Yeah, well, I just, it's going to be interesting to see. And the time, I think Chris Verone, frankly, nailed it here with this just an absolute soup out there. Wei Li today, a new regime. Is it a new regime for everyone we speak to?
Wei Li essentially answered Lisa's question, which is she didn't see reinvestment risk going at the short end, which is a short way of saying ultimately we think this new regime is here to stay. High yield's going to be with us for a while.
That to me was one of the biggest takeaways. It was pretty shocking. And if it isn't just going into the longer end of the curve, it's going into equities, particularly in emerging markets. In other words, there are other areas that will be good reinvestment moments. It's better to have cash and be able to be nimble at a time when you're changing your view 2 times in 2 months.
Some of this is the economic data we see. Let's review this, John. I think it's so important. Jobs Day is not normal this month. It's a bit delayed, and tomorrow we get the Faro statistics. You like the ISM tomorrow is the first real look of where we are.
So the so-called PMIs have been sub 50 for a while. And I think the question we were all asking is, what is the market doing up here? And the PMIs are sub 50. Something's got to give. Either the market's got to come down or the PMIs have got to recover. Both happened. The PMIs are north 50 again, Lisa, and I think that's indicative of an economy that's doing better than expected. And also, as we look to February, this is going to be an early read on the month of February after seeing a fantastic January with one big question for most people, I think, in this market at the moment. Can we confirm the January data with similar performance in the month of February? And there might be some indication that maybe we can.
So is good news bad news? And this is sort of the question, right? And I think we can throw it away because people right now are saying good news is good news. Stop it already with all the pessimism, because basically that's what you're feeling in a stock market that has more fear, Tom, of missing out than necessarily some view forward of pessimism at a time when they're willing to rally, even with a negative look for the year ahead.
We're going to be focused here on what we do, and we're going to look at the data right now, and then we're really going to dive. I'm looking at the Goldman Sachs PowerPoint, John, and I'll be honest, it's a lot of managed happy talk, and we got to look beneath it to see.
Isn't every investor day?
Well, the bottom line is what is written. I'm a big believer in that, and I'm looking right now at page 55, where quote, we're going to manage through a complicated credit environment. You think? That's the challenge they have.
Well, I think actually it's the fact that that challenge hasn't emerged in the way that perhaps we thought it would have just maybe a year or so ago. If you told me the Fed was going to do what it's done, the ECB is going to do what it's doing, and we wouldn't have what we've seen ultimately, I would have expected spreads on the periphery in Europe to be a whole lot wider. I would have expected credit spreads to be a whole lot wider than they are right now, and that's just not what's happening.
Well, market's clear, and the answer is corporations adjust like the inventory of Target out the door. Let's clear with a data check right now. I don't really know what to make of it. I'm going to go to 210 spread, which is round trip. We were at 90 basis points for a cup of coffee, and then turned back around and had less inversion, John, and we come back now to negative 87 basis points. It's a round trip on inversion just since Friday.
Well, let's take the 2-year piece of that. So I'm just accelerating over the last month, just a massive lift on a 2-year through 480. On a 10-year, ultimately getting closer and closer to 4%. We try that again, up a basis point at 392.78. And to your point, the next big stop is payrolls next Friday, 2 Fridays away.
Sarah Malik joins us right now. Let's jump into it, a chief investment officer at Nuveen. Sarah, what has changed in your outlook in the last week or so? We have whipsaw. We are in shock, back and forth. What has changed in the Nuveen placement?
Markets are adjusting to the fact that the Fed has more work to do. And this is monetary tightening is not taking a bite out of the economy. This is bad news for inflation and bad news for the market. So I think the markets generally stay in a trading range, and the Fed stays in a holding pattern with rate hikes and then a pause until we can get some kind of break on inflation in terms of wages or shelter or spending on services. And we're just not really seeing that yet. And that's why we're generally thinking that the market's going to have trouble continue to move to the upside, likely a trading range or downside risk from here.
Let's talk about the Whaley point, that basically it's not worth necessarily going into the long end of the yield curve at 4% if you can get 5% at the short end, because you could potentially get higher yields and you could potentially get a better opportunity elsewhere. Do you agree with that stance?
I think generally that is going to be the case going forward, with now about 3 hikes getting priced into the markets for the Fed, and then again, no rate cuts in the future, likely a pause. And then if inflation doesn't break, you could even see more hikes from there. I think it is the short end of the yield curve that's going to continue to look more and more attractive versus the long end.
So where are you looking for in terms of getting some sort of returns other than the short end? Are you starting to see opportunities in industrials, as we were talking about earlier? Are you starting to see opportunities in retail like Target that came out with expectations that were disappointing, but everyone still seems to be cheering?
So starting with retail, I think, consumer and the employment markets are going to be the piece of the puzzle that determine the depth of and the timing of a recession. So consumer, I think, is at risk. That's not an area that we're incredibly interested in. We're more on the conservative side, looking for quality companies and also some beta outside of the U.S. So starting in the U.S. with quality companies that tend to grow their dividend, they tend to have strong balance sheets. They're more recession resilient, provide you some income protection going forward. So this is everything from infrastructure companies that are backed by utilities and waste management, all the way over to companies like Linde or Coca-Cola, which tend to be a bit more defensive in a volatile market. Now, outside of the U.S., we think emerging markets look attractive because of valuations there, also the dollar, which may not be as strong as it was last year, and also China continuing to reopen. I think EM finally has a tailwind. You could see some upside there. So kind of a balanced bet there, but staying a little bit more conservative in the U.S. because of the continued rate hikes that we see and the potential for a recession that may be delayed but likely still comes.
How does use of cash play in? I mean, the Journal's got the article out on 1 trillion share buybacks. We saw Chevron, Mr. Worth, make a statement today. Define use of cash for Nuveen.
Well, first of all, just going to look at energy companies, I think that we've seen this with them for quite a number of years. They are more focused on returning cash to shareholders than on pulling barrels out of the ground. That's keeping supply tight for energy companies. And we agree that oil prices likely have more upside because demand remains reasonably strong, supply remains tight. Cash is an interesting asset class in the sense that it is paying good yields. My caution in terms of cash, though, of course, is that the markets tend to price in a recovery well before we see any of the data. So it's a timing issue. And when you're trying to time the markets, usually that's generally a loser's game. So while it's important to keep some cash in hand, I would continue to look for areas where you see good value. Now, these are areas like non-U.S. markets, particularly emerging markets. Also in alternatives, private credit tends to be more resilient during a recession. If you look at historical downdrafts in the markets, private credit tends to hold up better. And then conservative equities like dividend growers tend to be more resilient. That's where I'd be looking to put my cash.
Sir, I'd be rude if I didn't ask the Nuveen heritage. Should we take advantage of municipal bonds this morning?
I mean, fundamentals versus the valuations of municipal bonds are at a mismatch because of the strength of the economy and the tightening that's not impacted the economy yet. Municipalities still look very strong. So fundamentals are strong, valuations look interesting. You're seeing total returns in municipal bonds and also areas of taxable fixed income such as leverage loans that still look very attractive to us. And again, that's why it's important to make sure you use your cash wisely, because you are seeing entry points that you haven't seen in years or even decades in many of these asset classes, such as fixed income.
Sarah, I've always wanted to ask you this question. How did Nuveen become the largest manager of farmland assets on the planet?
This is a historical asset class that we've been very heavily invested in all the way back to when the TIA days as our parent company. It's an asset class that we thought was very resilient. It's a great asset class as a hedge to inflation. So it's just a very strong asset class and important, obviously, to society. We've built it over time, and it's become, I think, in a world where equities and fixed income have become very correlated, alternatives such as farmland have been a very important piece of investors' portfolios.
And they continue to be correlated this year as well, even when we were expecting that to break. Sarah, just wonderful as always. Sarah Malik there of Nuveen. That's been a theme of the month so far. Bonds falling, equities falling, yields up, stocks down. How many times have we woken up and said yields up, stocks down? Equity futures just about positive this morning by 1/3 of 1% on the S&P 500. We had Target a little bit earlier. The outlook not great for the first quarter or the year ahead. We've got a Goldman Sachs Investor Day kicking off in New York this morning, Tom.
We do, and what we're going to do with surveillance is actually look at the 118-page PowerPoint. Shonali Basak leading us on it. Thank you, Shonali, for the first look at that. John, I've driven into it, and you need to get to page 63 to see the Mike Mayo page. The executives, all of them can come out with platitudes. It's loaded, as you would see at any investment firm, with the positive. One Goldman Sachs. It's like one surveillance. It's a big theme as well, one Bloomberg. But what I would say, John, is the money charts on page 63 to look at, where they look at very optimistically net charge-offs in the consumer banking rolling over and doing better towards 2025.
One Goldman Sachs.
That's
nice.
Front and center, that's page one. We get that page one and repeatedly throughout.
Shonali Basak coming up next to talk about it.
One Shonali Basak.
One Shonali. Just one Shonali.
One Shonali. Yeah, I like that. One Shonali.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Supreme Court hears arguments today on President Biden's move to slash the student debt of more than 40 million people. Republicans contend that the president is overstepping his authority on the move, but Biden put a freeze on federal student loan payments back on his first day in office. In the UK, Prime Minister Rishi Sunak's government has a hard sell. It has to convince politicians in Northern Ireland to back the post-Brexit deal reached by Sunak and European Commission President Ursula von der Leyen. Sunak spoke with reporters in Belfast.
I'd like to engage with the parties, and it's one of the key parts of this deal. It safeguards sovereignty for the people and institutions of Northern Ireland. It's what people were asking for, and the Windsor Framework delivers it. And I think it's more than anyone expected, and I hope that's why people can see that this is a really positive step forward.
The agreement is aimed at fixing a provision of the Brexit Treaty that effectively imposed a customs border in the Irish Sea between Great Britain and Northern Ireland. And Target turned in a strong fourth quarter performance, but the discount retailer offered a cautious financial forecast for this year. Target's outlook for fiscal year earnings is about 50 cents a share lower than the average analyst estimate. The chain's big problem is shaky demand for discretionary goods. And Apple suppliers rushing to move production out of China far faster than observers anticipated. That's according to one of Apple's most important partners. AirPods maker is one of the many manufacturers exploring locations beyond its native China. It's trying to avoid fallout from escalating tensions between Washington and Beijing. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
You'll always remember buying your first car, but the
Going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK is getting ready to make
are moving back both in growth and inflation to what we would refer to as the old normal, that pre-COVID growth rate closer to what we saw in 2015 to 2019. And we think January, while it was certainly a good month, certainly a warmer and stronger month, will prove to be a bit of an anomaly as we go forward.
Great to catch up with Gene Tenuto there, the Global Head of Fixed Income at Columbia Threadneedle. What a year already for fixed income. We were told it was the year of fixed income, the year of the bond, and then the bond started to get in a little bit of trouble over the last month, particularly the front end of the yield curve. Your 2-year much higher, your 2-year a whole lot softer, yields a whole lot higher. The story in the bond market looks like this right now. Yields just a bit higher on a 10-year maturity, up a couple of basis points to 3.94 in the FX market, from a high of 110.33 to a low of 105.33, all in a month, and right now 106.18, positive 0.1% on euro dollar, and futures trying to erase some of the monthly loss. Right now we're positive by about 1/3 of 1%, Tom, on the S&P 500.
Yeah, but John, with all the angst we've reported in the whiplash, to see SPX at 4,001 sort of surprises me. Given the angst that's out there, I think I'd see a lower statistic.
Well, think about how much higher we were on things like the S&P
where
500.
were we? 42, 43.
And on the NASDAQ. The NASDAQ at one point this year, I think, was up like 17%.
Well, no, I take the point that we've given it back, but you know, I don't get the feeling a correction or bear market. What I get the feeling of is immense ambiguity.
So Marko Kolanovic of JP Morgan
What did he
put
say?
out a
We
note
haven't talked about
yesterday.
him
Well, he
recently.
struggled with this market last year. He's struggling with it again this year. But ultimately, he thinks that the gap that's opened up between the bond market and equities needs to shut, and needs to shut with equities doing more to the downside. We've had this big correction in the bond market, yields up. Doesn't think we've seen enough with equities down.
No, we're going to have to see. Right now, what we're going to do, equities down, is maybe Goldman Sachs down. Let me cut to the chase. It's real simple. The book value doesn't match. Morgan Stanley 1.8, Goldman Sachs a lesser number, and the annual return over the last 10 years just isn't up to snuff. There are pressures on Mr. Solomon, but far more pressures on a name you don't hear from, and she is Stephanie Cohen. It's her job to fix what has now been called platform systems. On the platform at their Investors Day is our chief financial correspondent, Shonali Basak. Shonali, there's 118 pages here. I had to get to page 54 to the land of Stephanie Cohen. What have we learned this morning? What has the sell side learned about platform solutions?
It's official, Tom. It's going to take 2 years for this business to start to break even on a pre-tax basis. So it will take time to get through what happened here at the consumer business. There are a lot of questions about what they do from here with that business, but now they're trying to, listen, there's no subtleties here down at Goldman Sachs today. You walk in the door and there is a big black sign that says forward. They want you to try to look forward even as they manage through that loss that they have to manage through the next couple of years. Where are they going to make money? They say that their asset and wealth management business is where they're going to get another $1 billion, $2 billion in revenue, bring that up to $10 billion in management fees next year.
Does the sell side, do the securities analysis analysts there, and do Bloomberg Intelligence find integrity in their guesstimates out 2 years for platform solutions? Do they believe the PowerPoint charts?
Let me answer it this way for you, Tom, because today, to the extent that this is a scorecard for Goldman Sachs' management team 5 years into David Solomon's tenure, they give you the scorecard high up in the presentation. They've got you at the low end of their returns on equity, right, and their targets for the medium term, but they've missed on efficiency. That's where the rubber hits the road, and that is after 3,200 job cuts. So where can they find more efficiencies moving forward? Have they met all their goals? They haven't met one of the 3 of the goals that they set out. They have not, again, put out new goals. So the question here is, what do investors bite onto? And will this be a compelling enough day to give an investment thesis to investors beyond, above and beyond just meeting the goals that they've already set out?
What's the road ahead, I should say, for Marcus, for the consumer banking industry that Goldman Sachs has moved away from a little bit?
Listen, it's a tough environment because, as you guys were just alluding to, it's like not only loan loss is ticking up, you also have marketing costs associated with businesses like that. Deposit betas are going up across the entire industry. There are big questions about it. But I think another question to ask here to kind of pivot to what the future is asset and wealth management. Goldman is trying to say that they're going to reduce their balance sheet, this $59 billion balance sheet at the end of last year in alternative investments, down to $45 billion next year and $35 billion over some period of time. They may give a bigger time frame soon, but is that enough to reduce the volatility that's associated with Goldman Sachs is a looming question, when really you have to look at asset and wealth management as the future. That's what management is saying it is.
How many questions are there among the analysts in the audience there about the potential leadership of Goldman Sachs going forward?
Certainly there will be a lot of questions. Listen, we're about 10 minutes away from David Solomon addressing investors himself. The mood is quite tense. I've spoken to a few sell-side analysts here and asked them what they're going to ask, and they looked at me, they said, I have no idea. So there are a lot of questions that are looming. Again, this is a more than 100-page presentation on the progress that has been made under the 5 years here, or at least since 2020, since the last Investor Day, the first Investor Day ever held at Goldman Sachs. But here we are again, kind of mapping out the future once more. I will say one more thing. We haven't talked about just the main business in the room here, global banking and trading here, because that is the thing that they're going to start off with and tell you that maybe they should be rewarded more for that business that has gained share over time. You look at how it's performed, that's where they have been able to show their cost efficiencies at the end of the day. So we will hear from the top leaders in that business as well, very high up in the program.
So, the oddest thing to me of this 118-page opus is I get the spin at the top. Any good company's going to do that. And I give Mr. Solomon great credit for the divisions that are doing well. As was discussed yesterday, they have a problem. How is Stephanie Cohen going to fix the problem?
And it's interesting, too. Remember, whether you're Stephanie Cohen or Mark Nachman, who is now running the global asset and wealth business, the succession story at Goldman Sachs about putting leaders up to a place where they can succeed. Stephanie Cohen, the woman that you had spoken about, was a former investment banker who had gone over to run this consumer business, and there was a time that she was seen as a rising star, potential successor one day to the helm of Goldman Sachs. Let's make no bones about it. And so, yes, what does it mean for her future here to turn around a story that they've given her a 2-year timeline now to make that business break even at the bare minimum? It's a huge question mark, and I would say the same for Mark Nachman, former trading executive who now has moved over to asset and wealth, and this is the new story for Goldman Sachs for him to lean into.
This is great, Shonali. Looking forward to your coverage through today. Shonali Basak there from the Goldman Sachs Investor Day. Tune in at 12 p.m. Eastern Time for Shonali's interview with John Waldron, the Goldman Sachs president, and Tom, the COO.
Absolutely original. You know, I don't know what to say about it. It's so important, John, as Shonali alluded to. So many parts of their business are nothing short of spectacular. Their place within Wall Street, their heritage within Wall Street. And they go off and do this experiment. You've failed at experiment. Lisa's never failed. But you and I have gone down in flames with different experiments along the way. Humility's in order here. I don't see any humility in that PowerPoint about how they move forward with a troubled consumer experience.
By moving forward, are you suggesting it should be cut?
It's not for me to suggest it. My answer is they need to address, as Stephanie Cohen does in some very elegant charts, the line of revenues, the line of charge-offs, some kind of delta they can make along the way. And as Shonali mentions, at minimum, the delta's out 2 years.
There's been a question about the identity of a bank that traditionally was the heart of investment banking on Wall Street, right? Morgan Stanley and Goldman Sachs were the two investment banking behemoths that didn't expand into consumer banking and some of these other sectors. And so now the question is the fact that Morgan Stanley has effectively really expanded really well with their wealth management unit and how much that's really helped them. How much do we see some sort of similar move by Goldman Sachs? And if it's not outlined, What's on the flip side of that?
We'll catch up with Shonali again in the next hour. Looking forward to that. In the next hour, to count you down to the opening bow, Victoria Fernandez across Mark, Patrick Fruzetti of Rose Advisors, Andrew Sliman of Morgan Stanley as well on this equity market. That's all coming up in about 30 minutes from now. Going into all of that, equity futures just about positive still, up 0.25%. What a ride through the month of February as we close out the month of February, looking at a monthly loss for the equity market. Likewise for the Treasury market, with yields aggressively higher ever since we got that monster payrolls report for the month of January in early Feb. Your next stop really is going to be Payrolls Friday, which is 2 Fridays away. Get in the diary. It's March 10th.
Next stop is the Faro 270-day report, March 31.
I can't wait for that to drop. Full outlook and our Investor Day coming up shortly.
One Faro.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The moment news breaks, no one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Bloomberg Surveillance, Lisa Bramlett and Tom Keene, John Farrow in preparation for a 9 o'clock hour as well. And the economic formula there is everything domestic, and then there's a foreign bolt-on, which has to do with exports and imports in trade. It is time to really firm up the nowcasting of the trade side of things, and we do that with Michael McKee with ignored data that's important all of a sudden, isn't it, Mike?
Well, it's important because it is a component of GDP, and it does suggest that GDP may be a little bit smaller than it was in the nowcasts, because the advanced trade goods balance for January comes in at negative 91.5 billion. It's down from 89.7 billion in December. So it does look like that widened a little bit. We also got some wholesale inventories numbers. They fell by 0.4. That's interesting because that suggests fewer imports came in, and retail inventories rose by 0.3, less than in December, but more than forecast. So we still have some inventory build going on. But the perhaps the most interesting thing I can say about all this is this sort of wraps up the January data. And now that we're in March, we'll start to get the February data, which is what's going to play a much bigger role.
Right where I wanted to go. Let's go to mere mortals like Stephen Stanley at Santander, just wonderful, or Stephen Rashuda. I'm only quoting Stephen Economist today. Stephen Rashuda over at Mizuho. And the answer, Mike McKee, is you say this is January data that we're wrapping up the end of February, and yet all anybody cares about is where we are March 31. Can they make an informed guesstimate now about this present quarter?
I don't think you can, because there's so much that's still outstanding, and the data that we have is for just 1 month out of a full quarter. And the Fed's got till March 22nd, so there's going to be a lot of data between now and then that will give us an idea of whether the January strength was the kind of thing that's going to be maintained or whether it's going to turn around, and whether the inflation numbers are going to ease off or not. But it's interesting to see all of the trading going on in the bond markets these days, and I know, Lisa, you've been all over it. The idea that everybody is moving yields up, but that's based on what happened a month ago. What's going to happen
but
now?
Lisa, the yield here revisits where we were the other day. I think you weren't in, but the answers of the 10-year 3.95. Am I on the 4% watch on the 10-year yield? I'm not sure yet.
People have been, and also the two-year yield close to the highest levels going back to 2007. What do you make of the fact that U.S. economic data has been surprising to the upside by the most since last May, at least if you take a look at the Bloomberg Economic Surprise Index? Is this because people's expectations were so low, or is it because the data is so good?
I think it's a combination of both. The expectations were low because people extrapolated out from previous episodes of what happened when we came out of recession, and the fact that it takes a while to get back up to speed, and people were nervous about spending and didn't spend. But that didn't happen in this recession, in part because the government gave away so much money. And what surprised everybody is the fact that consumers keep spending. Now, you remember the old days, we used to say, never stand between an American and a cash register. And that still seems to be the case, and they haven't run out of money yet.
Case Schiller at 9 o'clock. To me, it's always important, the memory of Carl Case and, of course, the wonderful Bob Schiller. Is it giving you good information, even though it's dated information?
It's giving us some information, but it doesn't help all that much because it is dated. But basically, it tells us where house prices are going. But unfortunately, it's delayed, and the Fed is looking forward, and they're looking at the more contemporary indicators to see what they think is going to happen. We'll see house prices hopefully continue to decline, but not a real impact on inflation until maybe May or June.
Michael McKee, thank you so much. Further economic data today, and then into a very, very busy, important March. Right now, and a joy to have in our studios is someone who was immense help through the pandemic. David Page is head of macro research at AXA Investment Managers. Great to see you here with us. I'm going to cut to the chase. I love one of the words you used, asynchronous, because that's what it feels like to me right now. Can we have a slowdown? Maybe not an MBE or recession, but can we have a, quote, media recession, whatever that phrase means, but some parts of the economy do okay?
Yeah, and I think the point that we make with asynchronous is that you can have slowdown in all of the economy, but at slightly different times, and that might defy the MBER definition of recession. So what we're thinking, and we were getting some of it in the data now, we've got this sort of nuance coming through from trade, we've got this nuance from inventory, so that's probably weak in the first half of the year. The consumer looks pretty solid though, and I think it's as we move into the second half of this year, particularly if we get the slowdown coming through in the labour market, that you'll see a softening in the consumer side. So typically, and this is why recessions are so difficult to forecast, at least in terms of timings, You get a synchronized slowdown, and that's when you see recession. If you get it asynchronously, one quarter's negative, then perhaps it's flat, then it's negative again. Remember, we've already had 2 quarters of negative growth that the NBER looked completely through.
Right.
And that wasn't a recession, in that was just last year. So we could get a sort of sawtooth pattern of GDP come through, which would be a muddle through. And I guess typically that would be a soft landing.
Rounded up, German yields are up solidly today, I might point out. I'm looking at the 10-year yield, 3.96 as a roundup on the 10-year yield. Okay, that's one story, but the other story is the disinflation to come. Model your trajectory of U.S. disinflation.
So we think that headline inflation is going to fall back to around possibly just under 3.5% by mid-year. But then
by mid-year?
By mid-year. But then by the second half
by Bastille Day?
We are a French house, but so sometime around June, yeah. But then, as we move into the second half,
okay, continue.
As we move into the second half of this year, we're expecting it to stay in that 3.5% to 4% passage. And that's why we've always said the Fed is not going to be in a position to be able to ease in the second half of this year, which markets have repriced quite significantly now. But we also think it takes a little while throughout 2024 to get that down, and they need to crack the labor market.
Well, here's the thing. When you're talking about an asynchronous recovery and a muddle through, isn't that problematic for getting inflation down? Isn't a muddle through eventually allowing certain industries to possibly see price gains that will keep inflation higher, even as you see sort of the year-over-year comps getting more complicated for the others?
Yeah, so to be clear, I mean, our view is still that we do see a mild recession. I stress mild, but we are looking at consecutive quarters of growth. But yeah, you're right. I mean, if we see this asynchronous, so growth is just slightly firmer than that, then the labor market doesn't loosen by quite as much, and that'll take a little bit longer for prices to fall. Ultimately, an asynchronous slowdown, a below trend growth, this is the sort of the baseline that Fed Chair Powell talks to. We get below trend growth coming through from the economy. The labor market eases a little bit, and that's enough to see inflation fall back. We think it'll be more than that, but no, that's exactly the risk.
We were joking earlier about how we have a show of people coming on and saying we have no clue, and then people ask us and we're like, we have no clue, because this is such a difficult time to really have a sense of what's going on. But I'm wondering how we can even be sure that that's enough to bring inflation lower, right? We can't, right? No. So if you have central banks that at least vocally are adhering to a 2% target of inflation, how do we know that we're not going to see a 6% Fed funds rate and a 4% ECB target, which is now priced into the market?
And I think that's the key risk. I mean, the central banks are pretty clear that they don't know either. I mean, we can roll back 15 months. We know the forecast errors that we all made, including the central banks, in terms of the inflation outlook. And the central banks seem to have learnt that lesson. But the point of that is that now central banks are using backward-looking information to judge when they've done enough with their forward-acting tools of monetary policy. So they're looking in the rearview mirror. They're not, I don't think, looking too much at inflation. The headline's obviously important, but it's the labour market that gives them the long steer as to inflation. And they're using that data to judge when they've done enough, when they know that rate hikes are still going to have a lagged impact on financial conditions going further forwards. And that, I think, is the biggest risk. If you're using backward-looking information to judge when you've done enough with your forward-acting tool, it sounds like a recipe for over-tightening.
Beautifully explained, and I guess the ex posti is becoming ever more ex posti, and there's some ramifications out there. We've observed, just as one theory, the Taylor rule is completely messed up right now. Torsten Slack over at Apollo models it near 9%, almost 10%. Bullard is saying, of St. Louis, is saying, let's go. There's others in the ECB saying the same thing. Let's go. Is there value to the urgency that Dr. Bullard speaks of?
Yeah, I think so. And I think, the move that you would get if you followed a Bullard type approach is much more consistent perhaps with Fed history, that you could see the rates move a little bit higher to peak, maybe, even towards a peak of 6%. But then once you reach that, you would break the economy. You would have to see rate cuts follow quite quickly. And I think what the bulk of the committee wants to achieve this time around is a peak that isn't quite as eye-watering as that, but it is held in place for a little bit longer. And that provides the restrictiveness that slows the economy further.
Before we let you go, the belief in lagged effects, is that enough for the Fed, for the ECB, to pause at a level before they see the ramifications of their forward tools?
No, they need to see some impact come through, and they need to see that in the labour market, and particularly for the US, 512,000 is absolutely nowhere near enough to see a slowdown in economic activity, and earnings growth, average earnings growth, needs to be closer to 3.5, and they'll need to see that before they pause.
David Page, thank you so much. Greatly appreciated. In our studios here, David Page is with AXA Investment Managers.
He came here just to experience the one and only real snowfall in New York City. And so he was saying, wow, here, you walk through slush. No, we do not this season, but now we do. And I just wanted to point that out.
For those of you worldwide, we've had a snowless winter, and it's, I don't know, it's sort of on the edge of, where I grew up, this is the second week of April. Does this get in the way of opening day? Joe Feldman on Target, of course, working with Dana Telsey Advisory Group. Obviously, he's under review off the conference call, but a very constructive outperform. And he talks about loyalty programs, about the target method, the execution method that they will have. We believe the company has multi-year profit recovery.
So just to give some perspective of what the optimism perhaps is stemming from, last year, Target had a decline of more than 30%, just to give you a sense. And Target's was about 2%. They had a 35.6% decline in 2022. So they're coming from a fairly low base, and their outperformance this year is coming after that. They were thought of as the gold standard for a long time in attracting people.
The execution standard.
The execution standard for service, for stocked shelves. Can they get back to that?
Oh, we'll have to see. I got 5-year dividend growth of near 11%. That's a starting point for a lot of institutional investors. And I've got a visible PE out to 24 of 18. So it's not the frothiness. Remember how frothy we were? The frothiness of a number of months ago has been taken out.
Well, I wonder if that's the reason why people are optimistic and they're out there buying shares, even though everybody else is saying, look, the world's going to fall when the Fed raises rates to 8%. No idea who that could be.
We will continue, but a data check is in order. I've got red and green on the screen. NASDAQ giving me a fractionally negative number as the SPX goes positive. A real churn to the market. We're going to blame that on David Page of AXA. Good to do that. The 10-year yield, 3.94%. We are watching yields.
Don't worry about
further curve inversion, negative 87 basis points. Please stay with us. This is Bloomberg Surveillance. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from the U.S. CHIPS and Science Act. The money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators did endorse false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied that it promoted false claims about the vote. And home buyers in the U.S. are increasingly paying in cash. According to real estate data analytics firm Adam, the share of all cash deals rose last year to the highest level since 2013. It was over 50% in 13 cities, including Atlanta. Meanwhile, the number of institutional investors declined, suggesting more regular buyers turned to self-funding to avoid higher mortgage rates. And Chevron is showing confidence in its ability to generate cash even after a 30% decline in oil prices. The energy giant will repurchase stock at a rate of $17.5 billion annually starting in the second quarter. Previously, Chevron planned a $15 billion buyback rate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
We're going now into a period that I think will last probably the rest of the decade, frankly, with inflation in the 2.5% to 6% type of range. That creates economic uncertainty, creates economic volatility, and that creates dispersion.
Luke Ellis there of Man Group, finally with some pretty good data there. We'll have to follow that. Claire carefully out of London. Good to see him there now with futures up 4. Just a churn to the market is how I'm going to put it. With a VIX under 21 gets my attention off the economic data. Thank you, Mike McKee, for that. The 10-year yield 3.94%. I guess I'm watching carefully. What's the single statistic, Lisa, today you're watching?
Well, I'm watching the housing market in particular, and I think it's interesting following on with Torsten Slok. If you see a reacceleration where you don't see a decline as much as people think in housing prices, what does that do to this feeling that that component of the inflation read will go down pretty consistently throughout this year? Does that kind of defy that?
Yeah. In the beginning of our days, folks, of Bloomberg on the Economy and Bloomberg Surveillance, we thought we would speak to Global Wall Street. And with great respect for the heritage of Goldman Sachs and for the challenges Mr. Solomon has faced after the tenure of Lloyd Blankfein, we thought we'd bring in an adult to actually explain what is in the ether, if you will, at West Avenue. Ken Leon joins us right now, Director of Equity Research at CFRA, truly with decades of exposure. Ken, is this any way to do business? I mean, CFA1, you got a John Deere annual report, maybe you got something else and this and that, and now we've got 118-page PowerPoints with a welcome from Mr. Solomon, a state of the franchise from John Waldron. Sonali Basak will speak with Mr. Waldron at 12 noon, very important. And then we have one Goldman Sachs. Is this a branding exercise, or do you guys like you learn anything out of these soirees?
Well, it's great to be here. And Goldman is probably best in delivering messages and roadshows. I mean, that's what they do as an investment bank. And it's all about what they're doing right first, and then they're going to get the hard questions later. They speak to client franchise. And essentially this means that everyone wants to do business with Goldman, particularly the investment bank and also asset and wealth management. But what's interesting here is that there's a lot of hard questions about their strategy from 3 years ago to kind of button up with shareholders. They got a $30 billion authorized buyback, and they're talking about capital efficiency, because they still are a regulated bank. It's a lot of questions today.
To sum it from an amateur, that would be me, folks. Stephanie Cohen shows up at page, I believe, 54. And what she basically says is, can you give us 2 years to work this out? Is that how you read it, Ken Leon? Is they're saying we need a 2025 hope and prayer?
So the Goldman brand supposedly was going to conquer the consumer market, and it didn't. And that might have been being too confident. And I think it's block and tackle the next 2 years, which will be profitability and return of capital. But the missing question here is that's great to be a great investment bank, but to be a great financial service company, you have to have recurring revenue, work through the cyclical parts of the market. And, we're talking about Schwab, BlackRock. These are stable. Morgan Stanley. Goldman Sachs still is an agent. It is really dependent on client servicing. That is always difficult to get a higher valuation. At the same time, I don't think they're going to make any big acquisitions. Right now, they just want to kind of have a calm where they can tell shareholders we're going to be more efficient, we're going to use less capital, and we're also going to find ways to be profitable and be smart, because they certainly weren't smart with their strategy before.
So there is a really big question within this, which is how are they going to expand more into that stable kind of business, the asset management that you're talking about, without making an acquisition, without making major investments, and without even laying out any kind of path to do so in this presentation?
100%. And when you look at their presentation, it's not going deeper and bigger in terms of asset management or alternative investments, because that's very choppy. It's going to be more the wealth management side, the advisory side, or in areas like Larry Fink had, which was from getting the iShares with ETFs. So in time, when they need to look for a more predictable recurring revenue stream and a lower source of funding, it might be some of the custodial banks or even State Street, which has, a great ETF franchise. Goldman would never look this way, but the market is saying, even if you execute and you have several quarters of great earnings out of the investment bank, we're not going to give you a higher multiple. So that's really the conundrum they have, and I think those are the questions that are going to come up today.
There's also a question about its existing consumer-facing platforms. I'm thinking about Marcus as well as some of the credit card partnerships. And right now, Dow Jones, Wall Street Journal is reporting that David Solomon, the CEO of Goldman Sachs, was saying today that Goldman Sachs is considering strategic alternatives for its consumer platforms businesses, including Green Sky and their partnerships, the credit card partnerships with Apple and General Motors. Does this mean that they're going to reduce their footprint and sell some of those businesses in the near future?
I think if it's any of the businesses that require significant capital, the answer is yes. For others, which are transaction-driven and they can leverage with partners, they'll certainly find ways that it could be incremental revenue and profit. But the big play is over.
Ken, I looked at the first grid chart, all of I think it's page 5 here. And they go against their leading peer, which is a Campbell's soup. It's like a minestrone soup of this firm, this firm, this firm. Baloney. The leading peer group compare is Morgan Stanley. To end this conversation, what did James Gorman get right?
James Gorman basically didn't go afar. So I have he was looking for adjacent markets like the workforce 401k with E-Trade. He paid premium, but he got Legg Mason. He got established businesses versus sitting in a room and saying, we got the best brand, which is Goldman, and organically, we're going to create businesses. It's very hard to do in financial services. That's the difference, Tom.
Ken Leon, thank you so much. A brief there from the esteemed Ken Leon, CFRA. I love talking to people with decades of experience that have seen the Morgan Stanley really ugly period that they had, I'm going to guess 20 years ago off the top of my head. Maybe I'm a little bit off on that. 16 years ago, whatever. The cycles here that Ken Leon's lived is a big deal.
Well, there used to be this race, right, between Goldman Sachs and Morgan Stanley. They were basically neck and neck, and people viewed them in the same ways, and Goldman Sachs always was out on top. And that equation has shifted, right? And people are looking at that and wondering how much of that's driven by the global wealth management business of Morgan Stanley, and how can Goldman Sachs get that back? What is their base that is going to really drive that revenue over the long term? And they're saying that they're going to make the margins bigger in their wealth management unit. That's some of the headlines that are trickling through. But fundamentally, if it's not consumer banking and they're not going to make acquisitions, how do they do it?
I'm going to push back on that a little bit. I look at the PowerPoint, which I think nicely displays the Goldman Sachs. They don't have the platforms to deliver leading number 1 M&A, number 2 ECM, number 3. I don't even know what the alphabet soup is, but they're number 1 or number 2 in everything. But And I think through the day and to hear from the different analysts such as Mr. Leon is that but is platform solutions, and they've got to address that. I believe, I'm speaking, glancing folks at 2 quick PowerPoint pages, their but is, can you give us some hope and time to 2025? Is that modern Wall Street? I don't think so.
Modern Wall Street is banning ChatGPT.
Where are you going to be June 30?
Yeah, I do wonder also what they say about their tech investments. He did talk about, David Solomon was talking about how he's tried ChatGPT and played around with it a little bit, but now a lot of the banks are banning it evidently. What do they do with artificial intelligence? How do they use some of these tools to make people more efficient, but then also get concerned, like prevent, but also prevent something from happening that they don't want to happen because we don't understand all these neural nets to the same degree.
It's no different than TikTok or WeChat or the rest. This stuff is a absolute compliance nightmare.
The concept of artificial intelligence is not, because if used correctly, it could potentially put you on the front foot of new technologies. So as a bank that's required to keep certain information safe, how do you be technologically savvy and efficient without compromising some of the safety and among other things?
There was a crypto headline out in the ether today as well. They're trying to deal with crypto as well. See, Lisa's just getting me going. I'm going to have to take this surveillance nap. Well, after Sonali Basak speaks to John Waldron is when I'll start the nap. Sonali Basak in conversation with the president, the chief operating officer of Goldman Sachs. Mr. Waldron, look for that, the 12 noon hours. Stay with us on radio, on television. Good morning.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Just to add to my anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, the Fed is explicitly trying to boost unemployment. Like, it seems like that is probably the worst environment for, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American at this point, or like anti the American dream, right? Like housing more expensive,
crushing the housing market,
crushing demand, crushing labor force. Like, what are going to be the social consequences of central banks, having to do this in order to put a cap on price increases?
They're going to be severe. We're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, laissez-faire policies, because there has been a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world, and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
closing out a really tough month of February. Live from New York City this morning. Good morning, good morning. Equity futures trying to bounce by about 1/10%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, bond slide as European inflation accelerates. Goldman's Investor Day kicking off in New York, and Target delivering a cautious forecast. We begin with a big issue, the American consumer.
This debate around whether or not the consumer is healthy.
The consumer is extremely strong.
Strong.
Resilient.
There's just so much data that has come out
That healthy consumer spending number.
that tells us that the consumer is very strong.
The state of the consumer right now looks pretty good.
Feels pretty good.
The consumer in the U.S. is still in a good place.
You have this really golden environment.
The labor market is just remarkably resilient.
Incredibly resilient.
The consumer will increasingly have more discretionary income.
Consumers will have the ability to keep the economy going.
The question really becomes, how long is that going to continue?
We need to keep things in context.
At some point later this year, you'll start to see the consumer crack.
Target offering another look on that story. Here's Bloomberg's Kaylee Lyons. Hey, Kaylee.
Yeah, well, the backward look, at least, John, is pretty healthy. The consumer clearly hasn't cracked yet because Target actually blew it out of the water on earnings per share, $1.89. The street was only looking for $1.48, and comp sales actually were up about 0.7%, whereas analysts thought they would fall 1.7%. So backwards look, thumbs up. Forward look, however, is a bit of a different story. Target saying at the maximum they expect to make $8.75 a share this year. That is about 50 cents below what the street was looking for, and that is due to just a lot of macroeconomic uncertainty, a lack of clarity around what is going to happen to consumers' discretionary spending. This is a very similar story to what we heard from Walmart last week. That said, when you look at the notes coming from the sell side this morning, they don't seem to be too concerned. Some of the words they used in those notes this morning include an unsurprising forecast, conservative, better than feared. And another reason the street is finding for optimism is the progress on working down inventories. Remember, during the pandemic era, Target did not have enough stuff and too much demand. That quickly turned into a story of too much stuff that people no longer wanted. Demand went down, and we saw massive builds in inventory, between 30 and 43% in several quarter periods starting a year ago. But finally, Target making progress. Inventory is actually falling 2.9% in this period. So that is a very important part of the story. It is leading to improving sentiment in the stock, which is not the chart we are looking at here. I believe that is a chart about inflation. But if you take a look at Target's performance on a year-to-date basis, not only is it up about 11% after its worst year since the year 2000 last year, a 36% decline, it is also outpacing Walmart. That said, this morning, though, John, the stock down about 0.4% in pre-market trading. So
Right now, at
not
least.
a massive move.
But that stock so far this morning, all over the place. Kaylee Lyons, thank you. I think it was down 4-5%, then up around about 5%. Got some breaking news just moments ago. Want to cross over to Abby to pick up on that. Hey, Abby.
Hey, John. Well, we do indeed have breaking news on Tesla, and they have announced that they are going to be building a plant in Monterrey, Mexico. This, according to Andres Manuel Lopez Obrador, AMLO, the president of Mexico and the United Mexican States. The stock is holding its gains. It's up about 1.6%. And I think an important takeaway here, John, could be, of course, because they've been discounting recently, there's been some concern about demand, but the fact that they're now going to be bringing more supply online in Mexico would suggest that maybe it's somewhat healthy. Again, the actual headline is that Tesla will be building a plant in Monterrey, Mexico.
That stock is up by about 1.6% in the pre-market. Futures positive by about 0.1%. Let's talk about this consumer in America with Crossmark's Victoria Fernandez, Morgan Stanley's Andrew Sliman. To the both of you, thanks for being with us. Victoria, first to you. Something you've said. You said you can think this economy looks great, but I don't believe it. Why is that?
I mean, Jonathan, we look at all of these things that people say, you know, look, the economy is strong, the labor market is strong, earnings maybe weren't as bad as people expected, PMIs are doing well, wages are up, and that's all true, and I can see how that's supportive of the economy. But look, you know I manage fixed income too, so I have that risk-averse side of me that says, wait a minute, leading economic indicators are down 10 months in a row. We have earnings expectations continuing to come down at a pace actually over the last quarter that is the highest it's been in the last 25 years without being in a recession. We still have the lagged effects of 450 basis points of rate hikes coming in, the inflation story that we can talk about with the labor market as well. And we've talked about M2 money growth falling. So those are the items that say, all right, hold on, hold your horses here. I don't think we're in a sustainable bull rally. I think the consumer does have some strength on their balance sheet because of the stimulus payments that are still there. I think we have about $1 trillion left of that. And because wages continue to be strong, because outside of the tech sector, you're seeing labor hoarding going on. And so I think because of all that, we've got maybe a mild recession coming, but not a deep recession. And that's all because of the strength of the consumer. I just don't think we can say it's an all clear from here.
I want to share some work from Ellen Zentner of Morgan Stanley, but I want to keep Andrew out of trouble, so I won't ask Andrew to comment on this. I'll ask Victoria. So Andrew, just be patient if you can. This from Ellen Zentner just moments ago. In the last 24 hours, she said, labour market catch-up, excess savings, lower energy prices, they're boosting the consumer, but a slowdown is still coming. We see the first cut delayed to March 24, followed by more gradual easing. So pushing out this rate cut call. Victoria, given what you've just said, does that stack up?
It does. I mean, Jonathan, we talked, a few weeks ago, and I said I can't believe that the market is actually pricing in rate cuts for 2023. I actually think we're going to see rate hikes continue probably into the June meeting, maybe even later into the year, depending on if consumer demand continues to be as high as it is. You look at that labor market right now, construction jobs, there's over 400,000 openings for that. You look at manufacturing, almost 800,000 openings in manufacturing. They're going to have to see wages continue to go higher because we don't have the migrant population that used to fill these roles here right now. There's a structural change in the labor market, and that's going to cause wages to go higher. It's going to make inflation stickier, and all of that, even though it's positive for a consumer, that tells the Fed their job is nowhere near done, and we're seeing 2-year yields across the board, not just in the U.S., but you look at Canada, Mexico, Singapore, India, around the globe at cycle highs. I think that tells us we still have a ways to go and no cuts until 2024.
Look at Europe this morning as well. You want to look at the Treasury market, 481 on a 2-year, up 3 basis points on a session. Andrew, credit where it's due. You came into 2023, you said there was upside risk to the equity market. That's materialized. I guess the question for you now, sir, given the sell-off this month, what now?
Well, I think the setup into March is much better than it was into February, which is, after a roaring January, sentiment got a lot more optimistic. The relative strength index got very overbought, and we were set up for a bad February. And now that, we've had a bad February, inflation higher and so forth, I think the setup is better into March. And, something that I would say about the consumer is, look, I'm an equity manager, and what I care about is expectations. And if you look at Target today, last year, if they reported this number, I think the stock would have been down a ton. But it was down 36% last year, as Kaylee said. And therefore, it's been de-risked. And the fact of the matter is their earnings, right, their earnings estimates got absolutely crushed last year. So the rate of change in their estimate cuts is actually slowing. So this is the key point I think people are missing, which is it's the second derivative of earnings revisions. And for many companies, not all, probably not for the mega cap tech stocks, for many companies, the rate of revision, negative revisions, is actually slowing. And that's why the stock is not down, even though it wasn't, they lowered guidance for the future.
So things aren't just getting as bad as quickly as they were before. Andrew, still
exactly.
Sounds pretty bad, but ultimately I get it, that it's about change for equities. So where's that theme more pronounced?
Well, I think you want to search for companies that that were crushed last year, that estimates have already been de-risked. And I think this is a perfect example. Many consumer stocks have been de-risked, not the market overall. The mega cap tech stocks, if you look at earnings revisions year to date, roughly half the negative revisions have come from 6 mega cap tech stocks plus a few energy stocks. I would be careful on those names simply because they didn't de-risk last year. Many of the consumer discretionary stocks de-risked last year. They were absolutely hammered. And to me, that's where you find your best opportunity. So I think inflation is going to remain sticky, but we're going to really find out how sticky to the second half of the year. I still think the first half of this year sets up pretty good for equities, and then we're going to find out more about the economy, about inflation in the second half.
Well, Andrew, to your point, discretionary year today on the S&P 500 up 12%. Worldwide, the airlines absolutely flying, forgive the pun. In Europe too, I've got Lufthansa up 26% from the close yesterday, not including what's happened today. Air France up by more than 40% year to date. Victoria, where are you on some of the discretionary names at the moment?
Yeah, so I think you do have to have some exposure to these discretionary names. We were at a conference last week with a lot of our clients, and the question was, how do we position our portfolio? Well, you need to have some exposure to some of those staple names. We like some of the healthcare, some of the HMO names, but you need to have some exposure to the cyclicality in the market as well, because I think it is going to be a churning market from here till the end of the year. I don't mean to be a Debbie Downer, but I mean, I don't see the market doing too much from where we currently sit for the next 9 months. So that tells us you have to be opportunistic and tactical. Look at some of those cyclical names. When they're up, trim them. When they're down, as Andrew was saying, then you can go in and buy some of those names. It's where the quantitative component of your model comes into play, not just the fundamental side. Look at the trends, look at those that have sustained themselves above their 200-day moving average and go into them. Some of those cyclical names, some of those discretionary names that works with credit cards. We like American Express. We added a little bit to American Express this week because, again, the strength of the consumer. So there's some opportunities there. I think you just have to be very cautious and be choosy.
Luxury in Europe, MS, Kering, LVMH, all up anywhere between 17 and 18% from the close yesterday, year to date. I look at the airlines here in the United States, Andrew. American year to date, 23% higher. United, 35% higher. Delta, 15% higher. Are there reasons, Andrew, then to stick with some of those names?
Well, I mean, first of all, yeah, consumer discretion is up 12%, but it was down 37% last year, Jonathan. So let's keep that in mind. First of all, number two is, keep in mind the University of Michigan consumer sentiment hit an all-time low, 45-year low last year. So the rate, again, the second derivative, it is about that things are going to improve. The sentiment is improving. So I wouldn't necessarily buy the strongest ones. I would look for areas that have been hit, like the home furnishing. Those they were crushed last year. Home apparel. I understand they've had bounces this year, but to me, that's a very intriguing area because I think things are getting worse.
Let's throw some research into the mix. Mike Gapen, Bank of America. This is what he had to say yesterday. He said a big slowdown in consumer demand might be needed for inflation to return to 2%. This could require several more Fed hikes. So, Victoria, let me ask you this. If you're long consumer discretionary, are you fighting the Fed?
No, and Jonathan, I have said all along, the market was fighting the Fed, and I couldn't understand why they were doing that. And we're not saying go 100% into consumer discretionary. We're saying have some exposure because there's going to be a lot of volatility in this market, and you want to be able to have some balance in your portfolio and take advantage of that. But I don't think you fight the Fed here. They have told you over and over again they're going to be higher for longer. Look at what the Fed funds futures have done over the last few weeks. They've gone up, 50, 60 basis points. I think it's around a 535 now. We still have a ways to go. So I don't think you want to fight that, but I think you can be opportunistic. Add a little bit of fixed income in there. Look at those short-term yields. If you see some opportunity on the long end of the curve, lock some of that in too, because we're probably getting closer to the top on the long end of the curve because of what inflation expectations are doing. So I think you have to tie all that together. Don't go long all in one area. You have to be choosy. And look, Target said today, inventories on discretionary are down 13%. That was the issue they had last quarter. So the consumers are out there. They are buying. You just have to be cautious.
Futures, just about unchanged on the S&P. Victoria, Andrew are going to be sticking with us. Let's get you some movers. We can do that with Abby. Morning, Abby.
Morning, John. Well, if we take a look at the shares of Chevron, we are going to see that they are popping. Yes, oil is higher on the morning, but we also have Chevron announcing that they're boosting their buyback program by about 17%, from $15 billion to about $17.5 billion. It could go as high as $20 billion, really trying to create shareholder value. So those shares, again, popping, really almost soaring, moderate soar, I guess I would would say. Zoom up 4.3%. Out of the doldrums for at least now. The stock, of course, from its peak down more than 87%, but in the most recent quarter, it was okay. They also boosted the profit forecast to 96 cents to 98 cents, about 13% better. Large customer solid. So right now, a little bit of life for Zoom. And then finally, Norwegian Cruise Line, not so much, down 6.4%. The fourth quarter loss was wider. The forecast is a bit disappointing. What's interesting is bookings are solid, revenue solid, John, but it seems as though they're not managing the cost so well.
We don't cruise on this show, as you know, Abby. Thank you for that. That's the latest on some of those names. Coming up, Eurozone inflation surprising to the upside.
Inflation is returning, and this must be our biggest concern for the central banks. So in order to avoid that, we must move much more towards targeted intervention, targeted support.
That conversation up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Inflation is returning, and this must be our biggest concern for the central banks. So in order to avoid that, we must move much more towards targeted intervention, targeted support, and not the big water hose splashing water everywhere. That will only fuel inflation, and that is the worst thing that can happen.
Inflation surprising to the upside in Europe. Spanish CPI unexpectedly accelerating. France delivering a record high print this month, sending bond yields across the Eurozone higher, with investors briefly pricing in a 4% ECB terminal rate. Mike McKee. Mike, do you remember, not even a month ago, when Chairman Powell said the disinflationary process has started, then a day later, President Lagarde turned around and she said the risks around inflation are becoming more balanced. That feels like a lifetime ago.
Well, it was only this morning, John, that Philip Lane, the ECB chief economist, went out on that same limb. This is what you don't want to be saying when you get surprise inflation numbers. There's significant evidence that monetary policy is kicking in, Mr. Lane told Reuters today. And then a couple hours later, we got inflation reports from France and Spain that shocked to the upside. France, supposed to be unchanged, goes to 7.2% from 7%, and the Spanish inflation number, 6.2% from 6%. And on top of that, both of them setting records for Eurozone era participation for their headline and core rates. They're at new high levels. And because of that, we're seeing quite the reaction in European markets. Break-evens have gone to new highs for the year, and for even longer than that. We're seeing rates rise significantly across the Eurozone, and even in the UK, 10-year break-evens at a 2-month high, and that's a reaction to what's going on in Europe. We are seeing the reaction in U.S. bonds here as well, and as you mentioned, the ECB benchmark rate trade has really gone up. You can see where we are now, and you can see where the terminal rate is now forecast by the markets, just under 4%. So at this point, all bets are off. And the interesting question that was brought up this morning is, if the ECB is going this high and the Fed is going as high as we think it's going to go, then we're going to have a really synchronous tightening of credit around the world that may feed back on itself.
Just surprising, Mike, to see the numbers at these levels in Europe. Just remarkable. Mike McKee, thank you. I think that question Mike asked is really, really important. Victoria Fernandez, we're going to have more hiking at the ECB, more hiking at the Federal Reserve. I want to go back to the Fed earlier this month. February 1st, on a Wednesday, Chairman Powell, disinflationary process has started. The 2nd, on a Thursday, President Lagarde turns around and says the risks around the inflation outlook are more balanced. What on earth happened?
Well, I think people were looking at just certain elements of inflation. They were looking at goods producing sectors, which we've seen disinflation there. And we knew that that was going to happen as supply chains improved across the globe. I think when you look at Europe, there's some expectation that because the energy crisis was not as bad as what people expected, that you would see some disinflation coming in that area. And what's happened is that there's other elements that are feeding through that are keeping levels higher. Services inflation in the U.S., I understand people think rent inflation is, elevated and it's higher than it should be, and that's going to come down. But let's look at other elements. We talked about the labor market. We talked about labor hoarding that we have there. I think we've got a debt ceiling debate coming at us that's going to cause some more issuance. We've got stimulus packages around the globe that are going to be causing some issues. You've got China opening up. So there's all sorts of underlying elements, kind of undercurrents that are feeding that inflation component on the services side, and people have been so focused on the goods side. We also have to look at, are they going to stick with a 2% inflation target, Jonathan? I think this is a key issue people have to look at. The central banks say, yes, we're doing that. I'm not so sure. I think they get around 3%, and they're going to say maybe that's good enough because they don't want to push the global economy into a deep recession. We'll have to see.
You're not the first person who's asked that question. I imagine a lot more people will do the same thing. Andrew, the ECB, we are pricing maybe a 4% peak rate. I've got no idea if that's going to be achieved. We're talking 550 potentially at the Federal Reserve. In reality, I can get 5% right now on a 6-month T-bill. Andrew, how much of a challenge is that to your equity market?
It's a big challenge. It's a big challenge. I hear all the time from advisors, why should I take the risk of equities when I can get, 4 or 5% risk-free? And that's the issue for stocks. The problem with that is, if you lock in a year from now and rates do eventually come down, I think Victoria's dead on right, which is I think we're going to 3%, we're not going to 2%, then equities will be higher and you won't get the same yield. And that's, it's kind of classic, Jonathan, early cycle, which is, in the 90s, I was a financial advisor and clients would come see us and say, I'm not greedy, I just want 10 to 15% returns without a lot of risk. And now people are saying, I'll take 4% risk-free. It's a sign of, what Warren Buffett says, people drive looking in the rearview mirror. If you can get 4% risk-free and last year you lost money, you take the 4%. But if last year the market was up 20%, you don't take the 4%. Yeah. So I think it's just a sign of where we are in the cycle, which is very early. There's a lot of uncertainty, but uncertainty creates opportunities, as Victoria said, not across the board, but selectively.
Well, again, it's either very early in the cycle or very, very late in the cycle. Andrew Sliman, Victoria Fernandez, to the both of you, thank you, as always. In the bond market, these moves in bunds, up 13 basis points on a 2-year in Germany. We're pushing 320. Coming up, the morning calls, and later, Hightower's Patrick Rossetti seeing opportunities in energy.
so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Equities turning just a little bit lower going into the opening bell. Let's get you some morning calls. First up, Bank of America downgrading Dish Networks to underperform, pointing to higher marketing expenses and adverse pay TV trends. Next up, Susquehanna downgrading Lending Tree to neutral, seeing limited upside with macro headwinds piling up. That stock negative 0.8. And finally, Citi downgrading Dick's Sporting Goods to neutral, expecting crowded inventories to continue weighing on gross margins. Coming up, Target topping earnings estimates but delivering a cautious outlook. We'll talk that next with Patrick Rossetti of Hightower.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
closing out the month of February, and we were looking for a day of gains, and that fades. Going into the opening bout, futures negative 1/10% on the S&P and the Nasdaq, down 0.2%, and heading towards a monthly loss for the S&P 500 and for the Nasdaq too. There's your opening bout. Switch on the board and get to the bond market. Month to date, yields much, much higher. Off the lows of the year, off the lows of the month, we are higher on a 10-year, on a 2-year. On a 2-year by something like 80 basis points, in and around. On a 10-year right now at 4 or 5 basis points on a session, 396.30. On euro dollar, higher the month, 110.33. That was the same day as the ECB. Lower the month, 105.33. Right at now, 106.24. Positive 1/10%. Euro just a little bit stronger. Next stop here is CPI day out of the Eurozone in a couple of days, and a read on German inflation, which comes tomorrow. Get this nice, lovely regional breakdown, and you can figure it out for yourself. You'll get that tomorrow. Looking at crude at the moment, 77.40 on WTI, up by 2.3%. And amazing to see inflation expectations start to build again without a rally in crude, unlike what we've seen over the last couple of years. At the open then, about 45 seconds in, your equity market looks a little something like this. The S&P down 1/10%, the Nasdaq down about 1/10% also. One stock to watch, Target, all over the place this morning. The retailer topping earnings estimates but delivering a tepid outlook. The CEO said this: "We're planning our business cautiously in the near term to ensure we remain agile and responsive to the current operating environment." Abby has more. Hey, Abby.
Hey, John. Well, this is interesting. The trading action on the morning biz earlier, of course, it had been lower, now slightly higher. And we do have CEO Brian Cornell presenting here in New York, and he just made comments saying that the coming years will be more like pre-pandemic era. In addition, there are comments from the Chief Growth Officer, Christina Hennington, saying that they're going to expanding more than 10 private label brands. So that's probably offsetting some of the weakness. I really like the way that Kelly Lyons put it earlier, saying that in the past, thumbs up, to the future, though, thumbs down, but it seems like a little bit of a mix here. So they really beat in a big way on both the top and bottom lines. But you can see here that what folks are concerned about for the fourth quarter, their comp sales did raise 0.7%. For the fourth quarter, though, they estimate down. As for the inventories, for the first time in a year, this is another bright spot. They are actually trending in the right direction. They are down. So perhaps, again, this is perhaps some of the piece of why investors are cheering the stock higher, despite the challenging environment and the pullback in discretionary spending that they're saying. This company, of course, their store somewhere between nice to have and need to have. Discretionary up 12% on the year. That, of course, is also Tesla and some of the travel stocks. But into today, and now with the gain, we have Target up about 12% on the year. Staples, not so much. So it's an interesting morning that we're seeing here as investors reconsider the strength that they had and thinking that maybe some of it will, maybe that the idea that they're a little bit conservative with that outlook, John.
Abby, thank you. Goldman weighed in on some of this. Here's the quote from Goldman Sachs and a team this morning. They said, hard to decide how to treat this. A very mixed bag. Comp sales are still intact, and they guided sales as expected. The issue is gross margins, missed by about double what most expected, and they did guide a bit worse. The stock just about positive in the early part of trade, and we'll keep an eye on that. Target up by about 1%. Sticking with earnings, Zoom Video crushing Q4 estimates, delivering an upbeat forecast. The stock's flying. Cost-cutting measures helping offset a slowdown in sales. The CEO saying this: while the macroeconomic situation continues to negatively impact our overall growth, Zoom is dedicated to maintaining a careful balance between growth and profitability. On that story, Isabel Lee. Hey, Isabel.
Hi, John. That's exactly right. So if you think Zoom and other pandemic darlings, if their days are numbered, you might want to think again, because Zoom shares are rallying today. It's on track for its biggest gain in 3 weeks. That's after the company reported fourth quarter results that beat estimates, and also outlook for adjusted earnings that were much stronger than expected. Zoom expects earnings to fall around 96 to 98 cents, and that's higher than the 87-cent estimate. So what's driving this? Well, you know, we've seen a slowdown in sales, but the company did employ aggressive cost-cutting measures. So recall that earlier this year, they slashed around 15% of their workforce. That's more aggressive than some of its tech peers. But it seems to be paying off, because analysts were very positive about the company's margins, and did note that its online business was continuing to decline. So that's not really a surprise, because people have been doing much less, you know, with the return to work policies. We have been doing much less. Zoom said many of its customers' defections have come from casual users. So this includes small businesses. So it remains to be seen what becomes of Zoom. Zoom is now touting products related to artificial intelligence. But if anything, the fourth quarter showed that Zoom is back on its footing. The stock soared in 2020, but lost most of its value in in the next 2 years. So it remains to be seen what will happen to Zoom this year. It's become an adjective after all, with people saying we're Zooming. John.
Down more than 80% from the highs of 2020. Incredible turnaround. Isabel Lee, Isabel, thank you. The stock's up just marginally in the early part of this session, 4 minutes into this session. One more stock to have a look at. Shares of Norwegian Cruise under pressure, posting a wider than expected quarterly loss. The company saying, quote, we're undertaking a broad and ongoing margin enhancement initiative. There's some real C-suite speak for you, in hopes of trimming costs this year. Katie, what do you make of that line? Undertaking a broad and ongoing margin enhancement initiative.
Margin enhancement. It seems like margins are the focus of this earnings season. And let's get specific on some of those numbers. You had fourth quarter adjusted loss per share. It came in at about $1.04. Analysts had been looking for a loss of about 87 cents. Then you look at adjusted EBITDA. The loss there was about $41 million. Estimates for $8.6 million. So a lot of daylight between those two numbers. You add that together, shares are down about 6% right now. And net income was also in the red. And unfortunately for Norwegian, that's a trend. It hasn't posted a profit since the start of the pandemic. Now, Bloomberg Intelligence points out that bookings, occupancy, they are solid, but cost-cutting efforts, they need focus. That campaign is underway. We're going to see if that actually does enhance their margins. But this comes after more than a 55% plunge for Norwegian over the past 3 years. If you stack that up against other travel stocks, you can see that Carnival is down, 60% in that time frame. Airlines down about 19%, not too bad. Your relative outperformer is actually Royal Caribbean. It did bounce back more quickly than some of those peers, and that does include Norwegian, John.
That 3-year story that you just painted, that looks brutal. Katie Grifo, Katie, thank you. The broader story right now, about 6 minutes in, no real drama. We're down about 0.25% on the S&P. The underperformance coming from utilities, coming from consumer staples. The outperformance, just relatively speaking, just about positive on the session. Energy. We're going to talk about that right now with Patrick Frizzetti of Rose Advisors at Hightower. He joins us right now. Patrick, great to catch up, as always, buddy. I know you like this sector, you like energy. Tell us why.
Yeah, sure. Look, I mean, when you look across the sector, higher cost of capital for marginal producers, China's reopening its economy, which is probably one of the biggest factors. And, there's still significant inelasticity of demand by poor nations around the world, emerging market countries. So we still look to energy markets in an inflationary environment to be very well supported.
Patrick, it's amazing that we started the year talking about China reopening and crude's barely moved. It's pretty much dead flat on the year so far. Do you need crude to rally to make that energy equity story work?
Eventually you do. I just think there's been nothing to really change the supply side of the equation, right? I mean, the regulatory environment is still pretty stringent, but demand has been pretty consistent, and I see that improving throughout the year. So I think eventually you'll see the price reflect that. Look, there's been a lot of economic noise in the data, so I think that's probably part of the reason you've seen a shift in sort of the weakening of the dollar and then the strengthening of the dollar, and then you see inflation numbers come out in Europe today, so maybe another slight weakening in the dollar. So there's been a lot of fluctuation to start the year.
Well, the capital returns look good. Chevron stands out this morning, that's for sure, Patrick. Chevron coming out and saying we're going to have a rate of buybacks of $17.5 billion annually beginning in the second quarter. Previously planned $15 billion. Are you expecting that across the United States, some of these big energy players? Do you expect it from the European names too?
Yeah, I definitely think so. It's about capital discipline. Returning, money to shareholders, I mean, is certainly one aspect of that. So whether it's buying back stock, special dividends, we've seen that in some of the parts of the sector as well. So I think it's just an attractive area to have some exposure to in this type of environment. And it doesn't take much to really be overweight the sector. I mean, it's still a measly, 4 or 5% of the total market. So I think to have some exposure makes some sense in this environment for sure.
Patrick, when things get tough, people say things like, we need to get defensive. We need to get defensive. And defensive can mean a bunch of things. It often just means whatever works when things are tough. And last year, energy was defensive because that worked when things were tough. Energy was up 59% on the year in that group. What's defensive in 2023?
Sure. So I think the term defensive means, what could potentially work in the environment we're in. And knowing that, if you're wrong, you're not going to drastically outperform. And so when I think about defensive, other than energy, I think precious metals will do well. I think a lot of consumer businesses, there's a lot to be said. I know you talked about staples a little bit earlier. I think while maybe household products underperform in an inflationary environment, I think things like beverages and areas in the food industry could work very well. And then obviously in the consumer side of the energy equation.
Is that discretionary services in the mix as well for you?
Yeah, absolutely. Absolutely. Because, that's one area where you can pass along inflation pretty easily, is in the services sector. So, we're beginning to see, across the board, particularly in the stocks we're looking at, look, there's always stocks to find in any environment. I think, Peter Lynch coined the term, far more money has been lost in the corrections themselves, lost by investors to anticipate corrections than in the corrections themselves. So I think you have to be active in this environment and trying to find the right companies and diversifying your portfolio appropriately.
Well, let's talk about diversification then. How do you diversify in a world where bonds and stocks fall together?
It depends where you are on the spectrum, right? So when you look at stocks, there are certain stocks that underperformed dramatically last year. You just look at some of the speculative excesses, particularly in tech. But then there are sectors like energy, consumer, healthcare that did very well last year. And in bonds, it's about duration and credit risk. So where are you on the spectrum? So you can be further out on the credit spectrum. I wouldn't be playing in sort of the non-investment grade market today. I would stay in high quality names, and I am staying sort of short to intermediate duration. So I think that's what you need to do to protect capital this year.
Patrick, appreciate your take on the market as always. Patrick Frazetti there of Hightower. Looking at the oil market right now, about 11 minutes into the session, equities are just about negative by not even 0.1%. The Nasdaq just about positive. The story of the morning, though, it came out of Europe. Upside surprise in France, in Spain, on the inflation side of things. You'll get a read from Germany tomorrow, then the overall Eurozone a day later. But for the bond market in the United States, it means yields are higher by 5 basis points at the front end. 482 on a 10-year, up 6 basis points. Very, very close to 4% again on a 10-year maturity. Let's call it 398 right now and round this one up. And take a look at what's happening in Germany, because in Germany, we've gone from talking about negative rates 12 months ago. I think the 10-year, or the 2-year rather, was negative about 70 basis points. At the front end of the curve in Germany right now, we're higher by 11 or 12 basis points to 3.16%. And we're pricing in potentially the ECB peaking at this rate hiking cycle as something close to 4. These were numbers that were totally unthinkable 12 months ago, and now we're having a real conversation about them. We'll pick up on that story a little bit later on throughout the day, and of course tomorrow as well. We'll get another breakdown of German CPI. Coming up, Goldman CEO David Solomon taking center stage in New York.
There were some clear successes, but there were also some clear stumbles. On the direct consumer businesses, we found them more challenging.
We're on Goldman's Investor Day up next.
Journey.
Japan's critical role in the global economy is changing as the world recalibrates. Our
After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
There were some clear successes, but there were also some clear stumbles. On the direct consumer businesses, we found them more challenging. It became clear that we lacked certain competitive advantage and that we did too much too quickly, which affected our execution.
Goldman Sachs and Chevron both kicking off their investor days this morning. Goldman leaders hoping to rally investors around the stock after profits slumped by half last year. This as Chevron is raising its share buyback rate despite falling oil prices. Your team coverage starts right now with Bloomberg's Sonali Basak and Anne-Marie Hordern. Let's start with you, Sonali. Just how big, how great is the pressure on the shoulders of that man?
Of course, there's a lot of pressure on Goldman Sachs at this point in time as the environment gets tough out there, John. But I want to point out a few numbers here because there's some really big proclamations being made here at the Goldman Investor Day. One being that they could cut another $1 billion in costs. We're going to see where those costs can potentially come from. Remember, Goldman Sachs already had a big wave of job cuts. But then the other here is this idea of considering strategic alternatives for that consumer business. So you heard David Solomon himself just say, you know, there were some real wins here, but there were also some stumbles. The question here is they've given you a 2-year track to get to profitability for this consumer business. Do they end up doing something different before that? Strategic alternatives typically means a sale or other alternatives for a business like that.
Different story, AMH, for Chevron. Should we talk DC buybacks and lead balloons?
Yeah, seriously, it is. This is going to be something that's going to certainly get a response at some point, Jonathan, right from the White House. What you've seen over the course of the past year is that this administration has lambasted the oil industry for what they say, and the president said this as recently as February 7th on his State of the Union, these excessive, outrageous, what he says, returns, and instead of putting them into the ground and pumping more, what he says, to bring down gasoline prices, they are giving them back to shareholders. At the same time, Jonathan, it's an awkward line, right, for the administration to walk. They're asking the oil industry to pump more. At the same time, this administration, they came in, they wanted to, President Biden wanted to be a climate president, and he's trying to get rid of the product in the long run that at the moment he's asking for more of.
When you do those news conferences with whoever it is from the administration, do you think someone might read that quote from Warren Buffett from over the weekend, Anne-Marie? This quote here, when you're told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. Is that something that might come up in Washington later?
It might certainly will, Jonathan, and without naming names, you can tell potentially where Mr. Buffett was pointing his finger at when he's talking about that. In the same State of the Union speech, the president reiterated something he's been calling for, which is quadrupling the tax on share buybacks across the board. So obviously the oil industry took a hit, but then he was aiming at corporations writ large, that these share buybacks should have a higher tax, and this is something he continuously calls for.
And that debate's not fading away, dying out anytime soon. Anne-Marie Hordern down in DC. Sonali, looking forward to your conversation later. Just a programming note so you all don't miss it. Sonali interviewing with Goldman Sachs' president and COO, John Waldron, a conversation between the two at 12 p.m. Eastern time, so about 2 hours and 10 minutes from now. Look out for that a little bit later. So the focus today on an investor day for Goldman, for Chevron tomorrow, it's Tesla's turn. This coming as the stock has more than doubled from its January 6th low, pushing Tesla closer to becoming the 5th most valuable US company all over again. David Welsh has more on this. David, what are you looking out for? What should we be looking out for tomorrow?
What's the continued growth story here? Clearly, the shares are on the rise in anticipation, at least in part, to what he's going to say tomorrow with the Master Plan 3. We could see the Tesla Model 2, which is the 25,000 or thereabouts inexpensive Tesla. That could give the company a lot of growth in an area where right now they're just not playing. Really, nobody is, except for maybe General Motors and to a smaller degree Nissan. So we could get detail on that. Maybe he confirms that the Cybertruck will actually go into production at the end of the year and talk about how much growth we'll get there. for the company. That's sort of one of the, let's say, several things that had stalled the shares out until this recent rise. Was investors are wondering, is the bloom off the rose? Is all the competition from the legacy automakers starting to eat into Tesla's growth? And if you've got a new small car, if you've got Cybertruck and some volume there, that could all help. I think he will talk about supply chain and how they're going to secure battery minerals and metals. Maybe they're going to start investing in mines and companies the way General Motors has. And then, look, you've got news this morning that Tesla's going to build a plant in Mexico. I don't think it's for the Mexican market. Mexico has 40 or 50 free trade agreements with countries around the globe, so that could be a big export hub for Tesla to open new markets with some cheaply made vehicles. Yeah, you look at all the auto plants down in Mexico. That's a huge export hub because you can get parts in tariff-free and you can send vehicles out tariff-free and you make them with cheap labor. So there could be an export story from Tesla coming out of this.
Hey, David, we'll catch up tomorrow, no doubt, on the Investor Day. David Welsh there on the latest here at Bloomberg. Broader equity market down about 0.1% on the S&P, pretty much unchanged, dead flat on the Nasdaq. Got some breaking news, economic news just moments ago. Mike McKee has that for you. Morning, Mike.
Morning, John. We'll make this quick because it's not particularly good news. Chicago PMI comes in at 43.6. That's down from 44.3 last month, and it was expected to rise. So raises questions along with some of the other regional PMIs that we have seen about what ISM will show, which is out tomorrow, 10 a.m. Wall Street time. It's expected to rise to 48 from 47.4. Now, the ISM manufacturing index has remained below 50. Services have crossed above. We get services later in the week, so a lot of attention will be paid to those.
Mike McKee, more data still to come. We'll avoid that one for now because that one was unexpected, I guess. Comes in below expectations, 43.6, the estimate 45.5. As Mike's pointed out all week, the ISM a little bit later this week, that is the one to watch. We'll pick up on that a little bit later in the week. We've got some time for some sector price action. We can do that, as always, with Abby. Hey, Abby.
Hey, John. Well, we have another low-volume day today. At this point, we have the S&P 500 down slightly. Not surprisingly, we have the sectors relatively mixed. No sector moving more than 1%. Most interesting, the sectors on the bottom, healthcare, staples, utilities down the most. That has to do with the fact that they have high dividends. Yields are higher today, so those stocks look less attractive. As for Norwegian Cruise Line, of course, it's down on the day on the outlook, but on the year, these travel gains that we've been talking about, John, it's really out of control. Hotels, the leisure sector, and then, of course, the media index, all in 2 months up really sharply.
Abby, thanks for that. That's the breakdown of the sector price action. Up next, your trading diary.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
about 25 minutes into the session. Equities totally unchanged on the S&P 500. Similar story in the Nasdaq as well. On the session, at least on the months, we are lower and yields are a whole lot higher. We'll pick up on that story through the week as we wait for Eurozone CPI in a couple of days' time. Your bond yield on a 2-year right now, 4.82. That's the price action. Here's the trading diary. Coming up, consumer confidence, top of the hour. Chicago Fed President Goolsbee speaking at 2:30 Eastern Time. President Biden discussing healthcare at 3 p.m. ISM Manufacturing and Tesla's Investor Day on Wednesday. And finally, President Biden meeting with German Chancellor Olaf Scholz at the White House to close out a week on Friday. Tomorrow, fantastic lineup for you. SocGen Sabadra Japa, Citi Stuart Kaiser, Morgan Stanley's Mike Wilson. We'll catch up with those three tomorrow morning. Looking forward to doing that with you. From New York City this morning, that does it for me. That rounds out my morning. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly